on taxation of the digital economy in Asia and the Pacific, latest options and the policy considerations. So a warm welcome to all of you joining this event, which aims to share the knowledge on the latest development of international cooperation on taxing the digital economy, and also the latest practice and in pioneering countries of the country of the region and from outside the region. So I'm glad that we have a group of very well-known speakers today. So I hope that we can have a very fruitful discussion. So this morning. So before we start, let me invite the director of the Macroeconomic Policy and Financing for Development Division of the ESCAP, Mr. Hamza Ali Malik, to give his welcome remarks and maybe also give a little bit background for this workshop and the work we are doing here. So Hamza, the floor is yours.
Thank you very much, Zhang. Distinguished experts, dear participants, colleagues, it's a pleasure to be here. Good morning and a warm welcome from Bangkok to this regional workshop on taxation of the digital economy in Asia and the Pacific. It is no exaggeration to say that currently we are experiencing very difficult economic circumstances globally and here in Asia and the Pacific. The COVID-19 pandemic wrought havoc on economic activities and public finances and exacerbated the challenge of effectively pursuing sustainable development. The ongoing war in Ukraine has only made matters worse. Substantial fiscal and debt pressures, along with rising inflation and increasing interest rates, suggest limited policy space going forward. Policymakers need new opportunities and ideas to strengthen their fiscal positions in order to cope with these challenges. This is the context in which we are having this workshop today. The global efforts to address tax challenges posed by the digital economy is reaching a critical point. On the one hand, the developing countries are confronted with a difficult choice between different approaches to tax the digital economy. These nascent options have implementation challenges, uncertain revenue payoffs, and sometimes high adoption costs, which is making it very difficult for policymakers of developing countries to take clear decisions. On the other hand, the pressure of action is growing. Developing countries are confronted with an increasingly urgent task to mobilize additional revenues to respond to constrained fiscal space, as I was alluding to a minute ago. Mobilizing more from the booming digital economy seems a natural choice, but which path to bet on? Which policies and approaches best suit domestic needs and local context? What kind of challenges and difficulties should we anticipate for successful implementation? Would the situation change and countries are compelled to switch to different plans, plans B, plan C, whatever those may be? All these questions are critical for policymakers and need further discussion. We do, however, see encouraging progress in recent years. For instance, negotiations on the two-pillar solution within the inclusive framework led by the OECD and G20 is moving forward. The United Nations has also proposed the Article 12B as a potential framework for taxing the digital economy. Countries which have already introduced taxes on the digital economy continue to gather policy experience, and more are exploring the options. There is now more to learn and potentially more truly actionable options to take. The Asia-Pacific region is not short of pioneers. India, for example, has accumulated years of valuable experience with the digital service tax and has been an active voice in the global debate on the subject. Others have contributed to the deliberations of the inclusive framework and towards the UN Tax Committee's work. However, most developing countries in the region have yet to take ambitious measures to effectively tax the digital economy. And the least developed and smaller countries continue to be marginalized in the pursuit of a global multilateral solution. So the objective of this regional workshop is to further inform Asia-Pacific developing countries especially those that have not made up their mind yet or have taken actions on the latest policy experiences and on the different options available to tax the digital economy, including their comparative pros and cons, and while all the while building on existing knowledge sharing and peer learning efforts. We are very delighted and grateful that a group of leading experts on this subject are here with us today to share their valuable insights and practical knowledge that can potentially inspire and guide the efforts to effectively tax the digital economy in Asia and the Pacific developing countries. I welcome you and wish you a productive workshop. This workshop is a valuable opportunity for the United Nations systems and other participating stakeholders to also hear from our member states and learn how we can better support Asia Pacific developing countries in taxing the digital economy. This is why we have actually deliberately included a dedicated session to hear from the distinguished participants on their needs and their ideas. We stand ready to provide national level training on the subject and encourage you to reach out to us should you have any need on this front. So without further ado, let me hand over to my colleague Zeng to moderate the substantive discussions, and I wish you a productive session. Thank you very much.
Thank you very much, Hamza. So before you may leave us, can I kindly ask all the speakers to turn on your camera first to have a group photo for this session? Thank you. Okay, I hope no one is taking the photo here. And then can I also ask all the the participants who currently join the session to also turn on your camera so that we can have a group photo for the bigger family?
I think the camera is disabled from your end. I can't turn it on.
Oh, I think that's the attendee session, the setting, right? It's blocked. Oh, okay. So sorry for this technical problem. So then we have to settle with the group photo of the smaller group then. Thank you for being here. Okay, so as Hamza introduced, without further ado, we will start the substantive discussion for today. So just before we start, just to remind you, today we have 3 sessions. So the first session, we'll talk about the different approaches for international taxation norms and on taxing the digital economy, which aims to provide an overview on the latest development in major international initiatives, and also a brief analysis on the differences and pros and cons of different approaches. The second session will be on options for developing countries, practices, and lessons. So this session will share more concrete and country-level experience on different options to tax the digital economy. And then the last session will be to facilitate the interaction between stakeholders and our clients, which are the member states. To also hear back from our distinguished participants today on what are your questions regarding the taxation of the digital economy, what are your current policy priorities and concerns, and what are your requests for the United Nations system and also to our partners in the region in terms of providing better support for your effort in taxing the digital economy more effectively. So due to the time difference, so we have one speaker today, Professor Cui, who is currently based in the United States. So it's already very late due to the time difference. So for consideration of this, we kindly invite Professor Cui to first speak and give you a presentation on the rationales and practices of the digital services tax. Just for everybody's benefit, Professor Cui is currently the professor of law in the University of British Columbia. So his research and writing spans a wide range of topics in tax law and policy, so including the international taxation, tax administration, and compliance, as well as tax and development. So his current research project examines the design of international taxation in light of the evolution of international trade And he also has rich knowledge for the Asian region, has written a number of very insightful pieces on the subject. So, Professor Cui, the floor is yours.
Thank you so much, Zhang. I want to thank everybody. It's an honor to be here and also to be accommodated into this first panel. I'm sorry not to be able to attend the latter second panel where I was originally scheduled. I tried to share my slides. I wonder if you can see them.
Yeah, we can see the slides properly, but could you put it in the slideshow format?
Absolutely. Are you able to see now?
Yes, from my side.
Okay, that's wonderful. I'm going to start. My talk today will be in two parts. In the first part, I will talk about the designs and rationales for DSTs. And in the second part, I will debunk some myth or erroneous claims that have been made about DSTs. So the first thing to say about the designs and rationales of digital services taxes is that there's a variety of different taxes under the same name. I'm going to talk about two main varieties. The first variety is the digital service tax as enacted in Canada, France, the UK, Spain, Italy, and some other countries. And this is a tax that you may not be familiar with in the Asia Pacific. It's a product-specific, self-assessed excise tax on certain business revenues of companies operating digital platforms. So I deliberately put this tax, give a description that's somewhat jargony. I want to convey the idea that this is a well-designed and carefully designed kind of tax. What I mean by product-specific tax is that the DSTs enacted by these countries tend to target three types of businesses: online advertising, social media platforms, and online marketplaces. So those are fairly specific products. Second, these are taxes that are self-assessed, and so the digital platform companies themselves assess their liability. So DST liability in a country does not depend on the receipt of payments from that country or the feasibility of withholding. And I'm going to explain why that's important. And finally, the DST in these countries is an excise tax. It's self-standing, it's separate from other major taxes that we're familiar with, including the value-added tax, the income tax, as well as other taxes. So that's one major variety. Another major variety of digital services tax, the Indian equalization levy was already mentioned. I think of the UN model Article 12B as describing a tax in that spirit. So if you think about the UN model Article 12B, it's a tax on automated digital services. This is significantly wider in scope than the three lines of products that I described on the previous slide. Although arguably you can still say that this is product specific. Second, withholding is the kind of mechanism contemplated in Article 12B. This presupposes payment from the DST imposing country, whereas on the previous slide, I mentioned that the DST imposed in Canada and other countries does not presuppose that payments are coming out of the DST imposing country. And then finally, of course, the UN model is situated in the income tax convention, and the possibility of taxing profit apportionment under paragraph 3 and the place in the income tax convention in the first place indicate a rule within an income tax regime. Okay, so there are some clear differences between the two main varieties of DSTs. They have all come to be called DSTs. Which designs are better? I think that's an interesting question, and the answer critically depends on the DST's policy objective. Here's one formulation of the DST's policy objective. It is to effectively tax economic rent earned by digital platforms operating two-sided business models that use non-rival technology to provide low or zero marginal cost services. And this rent is generated by participation of users from clearly identifiable locations. Again, this is a maybe complex formulation. It's a careful formulation just to show you that the design of DST can be very deliberate. I won't elaborate this formulation. I provide some links in the slides where you can explore this formulation. I would say that this formulation best rationalizes the type of DST introduced by Canada, France. Sorry, I don't know why this keeps on going forward. Introduced by Canada, France, UK, but perhaps not all DSTs. Okay, but I can explain this formulation intuitively by analogy. The DST, as conceptualized on the previous slide, can be immediately analogized to other sector-specific taxes on location-specific rent. What do I mean by that? Many of you will be familiar with resource royalties, which are low-rate charges on gross revenue that's imposed on natural resource extraction. And this kind of resource royalties are imposed by many national as well as subnational governments. In other countries, such as Canada, Australia, you would have resource profit taxes that are distinct from income taxes that are imposed by many governments. And so these taxes are imposed not on gross revenue, but on some measure of profit. But I think of them as similar in nature as the resource royalties. Resource royalties are typically not covered by income tax treaties. They're not creditable against income tax liabilities, either in the host or in the home countries. They coexist with income taxes and VATs and are not perceived to be challenges to the international legal order. So you can think about the DST simply as a tax on the extraction of a new type of resource, and that is user participation on digital platforms. So once you think about the DST in this way as a tax on location-specific rent, the question can be asked, why is the world so upset by DSTs? So now I'm going to come to the second part of my talk. I want to debunk some myth about the DSTs. I am going to restrict myself to 3 myths instead of 4 myths in the title. I want to start this part because unfortunately, compared to the previous slides, most discussions of the DST in the last 4 years have not shown interest in the DS detailed design at all. Instead, claims have been made about the DST that present them as particularly undesirable. I want to say that these following claims are all substantially false. The first claim is that the DST is discriminatory. The second is the DST is responsible for trade wars. And the third claim is that the DST is a cruder tax instrument than the income tax. I'll show you why all these claims are mistaken. Let's consider the first issue of whether the DST is discriminatory. I want to tell you about the Canadian DST. It was legislated last year and it's already in effect. Tax will be collected as of 2024 if the OECD agreement in Pillar 1 doesn't proceed. Under this Canadian DST, the DST is applied to all corporate groups with global annual revenue of 750 million euros and Canadian digital service revenue of more than 20 million Canadian dollars. Now you will note that the size threshold used here is the same used for country-by-country reporting under BEPS. Going through the letters of the DST legislation, one can determine that it will apply to multinationals from Canada, US, and other countries. Okay, so it's a broadly applicable tax. This has not prevented DST opponents from calling the Canadian DST discriminatory. And so the question is, what is the basis of this kind of claim? Now, if you think about the DST as imposed on digital platform companies, many of these companies come from a few countries. China and the US are among them. But it's also true that in other sectors, multinationals may specialize. So multinationals from certain countries specialize in certain sectors. Canadian multinationals, for example, are leaders in oil and gas extraction, and they engage in such activities around the world. A question can then be raised whether all taxes on oil and gas extraction are discriminatory against Canada. I don't think that Canada has made such a claim. Claims that the DST is necessarily discriminatory against digital platforms from a few countries should be compared to this kind of claim. We should also ask the question, what is the legal standard of impermissible discrimination? Is it enough that it feels discriminatory? This leads me to the next topic. The claim that DSTs are responsible for trade wars is also wrong. The reason is that many DSTs, including those in Europe and Canada, fall outside the scope of income tax treaties. As I explained, they're self-standing excise taxes. The same DSTs are also compatible with the country's WTO obligations. For example, they're consistent with the General Agreement on Trade and Services. This should not be surprising because DSTs are new tax policy instruments, and GATS is limited in success in removing barriers to the services trade. Countries simply have had no occasion to come to agreement about these kind of taxes before. It's very notable that the Office of the United States Trade Representative, in conducting and completing its Section 301 investigations against DSTs, did not allege that DST violate the above or other existing international agreements. So even the United States does not claim that there's any kind of violation of international law. Instead, it has simply made a determination based on no rule of law that DSTs are discriminatory. So the Section 301 tariffs against DSTs likely violate US WTO obligations. Countries targeted by such tariffs are entitled to adopt counter tariffs under the WTO against the US to enforce its WTO obligations. This fact is actually acknowledged in the OECD's economic impact assessment of the two-pillar blueprint in 2020. In the OECD model, it is assumed that all countries, except for the US, China, and Hong Kong, enact TSTs, presumably because all of the countries around the world, except for these countries, 3 countries, regard the DST as a good idea. Only the US retaliates against the DST. China doesn't, and Hong Kong doesn't. All countries that's targeted by the US tariffs enact counter tariffs that are sanctioned by the WTO. This is literally the scenario that's envisioned by the OECD model. If we look at these assumptions, we can raise the question, which is the country acting unilaterally, and which country is provoking trade war? My belief is that if you consider these assumptions, given the fact that all the DST imposing countries are violating no international law, whereas DST retaliation is in violation of international law, that's the basis for making an assessment of who's provoking trade war. And finally, my third point is against the argument that DST is a crude tax policy instrument. The European and Canadian DSTs are targeted at products with low or zero marginal cost, and therefore tax on revenue approximates marginal profit. It is efficient to tax pure profit, which is also called economic rent. This is a good kind of tax to seek to impose. And economic rent is easier to identify in specific sectors, markets, or products. It's much less likely for a uniform corporate income tax to capture economic rent. So any kind of income tax imposed on all types of companies is much less likely to capture economic rent. I also want to highlight the fact that in advanced economies with high levels of investment in intangibles, the traditional corporate income tax has struggled to correctly measure income. So much so that the US itself has enacted a book minimum tax in August 2022, which shows a sentiment or an analysis leading to the conclusion that the income tax, the traditional corporate income tax, is unreliable in measuring corporate profits. Now, so why do we think that it's so bad for taxes to be imposed other than income taxes? I think that's one of the major intuitions against DSTs. So this last slide, substantive slide, I want to raise the question, should countries use income taxes where possible? Income taxes are important revenue sources that in the 20th century facilitated the reduction of tariffs around the world. This does not mean that countries should rely only on corporate income taxes, any more than they should rely only on tariffs. Developed countries especially use multiple tax instruments with overlapping tax bases. So in the domestic policy analysis in developed countries, double taxation is rarely a conclusive objection to the imposition of new taxes. In fact, double taxation under different taxes is generally tolerated. International cooperation is possible for all taxes and not just the income tax. That's one thing that we need to remind of ourselves of. And the choice of the best policy instrument should determine what countries cooperate on. We shouldn't decide that we've cooperated on the income tax in the past, therefore to cooperate in the future, we should keep only income taxes and not consider other potentially better tax policy instruments. So in conclusion, much discussion of the DST has made unjustified assumptions about the primacy of one country's preferences, the primacy of a traditional mode of international tax cooperation, often in ignorance of other existing and successful institutions of international cooperation, such as the WTO. And the primacy of the income tax is also unjustifiably assumed. Discussions based on such assumptions contribute little to our understanding of optimal DST design, and so it's important to consider these questionable claims and then, leaving them aside, consider the actual design of DSTs. Thank you so much.
Thank you very much, Professor Cui, for sharing your insight on the DST analysis, especially on the misses and misinterpretations of the DST as a potential measure for taxing the digital economy. So before you leave, can I just quickly open the floor to our participants to see if there's any question that you may ask regarding Professor Cui's presentation and the digital services tax and how to implement and use them potentially for the tax purpose. I think you can raise your hand if you have any question. Yeah, please, let me see. Yeah, please go ahead.
Should I?
Yes, please go ahead. So could you first introduce yourself and then ask the question?
Yeah, sure. This is Shujat from Sustainable Development Policy Institute, Islamabad, and I'm also a student of Beijing University of Technology and doing my PhD over there. While looking at all these laws, how we are going to interpret them, particularly considering developing countries in the framework, because in developing countries, these laws have multiple meanings and some myths which, Professor, you have discussed, they might come as true. How should we deal with such kind of complications while taking into account developing countries? Thank you.
Should I attempt to address that?
Yeah, we don't have other questions at the moment, so please go ahead.
Okay, thank you for that question. One answer is to say that DSTs as imposed in countries like France and Canada are quite simple. And one indication of how simple that is that if you look around for tax practitioners, major accounting firms, tax advisors, to see if they try to explain the DST and try to sell services about them, you hardly find any. Whereas surrounding something like the OECD's Pillar 2 proposal, there are so many client alerts out there because tax practitioners want to make money from those rules. So I think that's a pretty good measure of the complexity of different law. DSTs are actually collecting tax revenue, and tax advisors hardly write about them. That's how simple they are.
Thank you. So we have another question from Rachel. So Rachel, you have the floor.
Hi, Professor Choi. It's nice to see you again. I'm going to ask you, I'm going to put you in a little bit of a spot here. Now, with the, how should I say, indefinite delays with Pillar 1, are we going to see a roundabout U-turn on DSTs being implemented? And also at the risk of encouraging developing and lesser developing countries to actually quickly jump on this bandwagon, really, what should a country be looking at before they implement any sort of DST?
Yes, thank you, Rachel. So DST versions of the DST, not the kind that that's enacted in Canada, of course, are being collected by developing countries, such as Nigeria. And so, I think developing countries' experiences should be considered, and there the calculus is about revenue and enforcement potential. So I think those things can be debated. I would not want to exaggerate the revenue potential of digital services taxes. I also don't think that the enactment of digital services taxes would necessarily or will even be likely to attract trade retaliation. And so the downside of enacting DSTs have been overemphasized, but the upside of enacting DSTs have still to be carefully considered. So in countries like Canada, where there's deep penetration of digital platforms, lots of multinationals having a broad scope digital service tax can raise a reasonable, respectable amount of revenue. That may not be true for smaller economies where digital platforms are more isolated in their operations.
Thank you very much. So I see no further questions at the moment. So Professor Choi, thank you very much for joining us. Oh, we have another one. So, okay, so we will have a last question for you before you leave us. I hope that is okay.
Of course. Thank you so much for the questions.
Sure. So Rosa, the floor is yours.
Oh, thank you very much. My apologies for raising my hand a bit late in the Q&A. So my name is Rosa Dakanay. I'm from the innovation team here at ESCAP. And my question is, what are some main barriers and challenges in adopting the DST in developing countries such as the Philippines and maybe even the ASEAN region in general?
Yeah, thank you so much for that question. I think the honest answer from me should be that I don't know, because I'm speaking from the perspective of Canada, and I've been engaged in analyzing DST by looking at the practices of the UK and France, their legislation. And so the assessment of DSTs from the perspective of developing countries is somewhat beyond my expertise. I think it's important to consider the challenges to their adoption. But if you look at mainstream portrayals of the DST, the main claims that we have seen are the kind that I discussed in my slides, and they don't address the questions that you're raising, which are, I think, better questions.
Thank you. So, so Fahad, do you still have a question, or it's fine? So if you want to ask a question, this is the last chance. Yes, the floor is yours. Fahad Yodashi. Okay, so unfortunately, we are not hearing the question. Okay, so thank you, Professor Choi. So in any case, we will share your slides on our this event webpage. And as you have said in your presentation, that you also have included useful links in your presentation, which our participants can check the related material if they want to. And in any case, you can always contact ESCAP if you have additional questions, and we can pass the questions on to our distinguished speakers and hopefully get a response. Thank you, Professor Cui.
Thank you
have
so
a very
much.
Good night.
Thanks to you
Thank
all.
you.
Bye.
Thank you. Bye-bye. So may I then formally start the session 1 on different approaches for international taxation norms on taxing the digital economy. And for this session, our first speaker would be Andrew Arbaci, who is a senior tax advisor from the OECD. So unfortunately, due to the time difference and the schedule conflict, Andrew is not able to join us today, but he has kindly recorded his presentation for today's workshop. So Charlene, may I kindly ask you to play the recorded presentation of Andrew? Thank you.
Good morning, good afternoon, good evening. Let me thank ESCAP for inviting me and for organizing this important workshop. I'm sorry this has to be recorded rather than live. And also greetings to my colleagues on the panel. The Asia Pacific region is an important one for the OECD. In tax matters, and it's dear to me as I was stationed in the OECD Jakarta office for 2 years as the senior tax advisor working in the region. Since my return to Paris last year, that role has been taken up by Melinda Brown, who I think many of you know quite well. We've been collaborating with many of the actors in the region very closely, for example, with the Asian Development Bank. They've launched the Asia Pacific Tax Hub to help countries in the region and implement the international tax standards, particularly around transparency and base erosion and profit shifting, or BEPS. Our work in the region covers a wide range of tools and engagement. We have 21 members of the inclusive framework on BEPS from the Asia Pacific region, as well as 28 members of the Global Forum on Tax Transparency. Our OECD UNDP Tax Inspectors Without Borders initiative has helped many countries in the region also by providing hands-on assistance with complex tax audits. With the help of TIWB, for example, as well as the Intergovernmental Forum on Mining, Minerals, Metals, and Sustainable Development, Mongolia issued its first transfer pricing assessment in late 2020 for approximately $228 million US, also with a denial of $1.5 billion US in carried forward losses. So we're having a real impact. We also work with the Asian Development Bank on a revenue statistics in Asia Pacific publication, and that includes 24 Asian economies, a really valuable tool for tax policymakers to benchmark their tax systems. In fact, in terms of our work in the region, I would like to advertise a regional consultation and workshop that we're organizing with the ADB, as well as with the study group on Asian tax administration and research, and the Pacific Islands Tax Administrators Association, as well as the Commonwealth Association of Tax Administrators. It's an in-person event in Manila on the 5th and 6th of December. We'll cover the most relevant topics in the international tax area with experts and panels on key issues for government officials working in that area. Now, the international tax landscape has seen major developments over the past year as part of a transformation to bring rules first agreed a century ago up to date for the 21st century. We've seen a lot of progress on transparency and the work on BEPS in making sure the rules work as intended. But we've also seen the exacerbation of issues stemming from the digitalization and the globalization of the economy, which have called into question the suitability of the rules in light of changing business models. This has led to the proliferation of unilateral measures, and with them the risks of double or triple taxation and trade retaliation. As part of the OECD G20 BEPS project, the inclusive framework has been working on addressing the challenges arising from the digitalization of the economy and on bringing a global consensus-based solution that can stabilize the international tax system and defuse the tensions that can only act as a drag on an already fragile world economy. On 8 October 2021, 137 members of the inclusive framework agreed the statement on the two-pillar solution to address the tax challenges arising from the digitalization of the economy. Since then, inclusive framework members have been working very hard to turn that political commitment into the legal rules and instruments necessary to turn it into reality. This work on the two-pillar solution is critical to stabilizing the international tax system. Very briefly, Pillar 1 of the two-pillar solution includes a reallocation of taxing rights over the residual profits of the largest and most profitable multinational enterprises, or M&Es. That's amount A. This means that the market jurisdictions where M&Es earn their profit will now be able to tax a share of those profits where the existing rules do not provide for this. Pillar 1 also includes a streamlined approach to applying the arm's length principle in transfer pricing cases, taking into account the needs of low capacity countries. That's amount B. This is often a very big obstacle for developing countries to tax their fair share of M&E profits. So a streamlined approach is a key outcome for lower capacity countries. Pillar 2 provides for a global minimum tax on large M&Es. This effectively puts multilaterally agreed limits to tax competition. Pillar 2 also provides for rules that protect developing countries' taxing rights over certain base eroding payments, the subject to tax rule. Both of these can have a significant impact on expanding the tax base for developing countries. There has been significant progress on both pillars. For amount A, we have issued a progress report this summer and further consultation documents following the recent Inclusive Framework plenary meeting. There has been significant progress on almost all of the building blocks that are necessary to put amount A together, but there remain a few open issues. While the proposed date to open a multilateral convention for signature by countries to give effect to the new taxing rights has been pushed to 2023, the Inclusive Framework remains committed to this work, and the delay reflects the need to get the issues right. The stability of the international tax system depends on rules that meet the concerns of all Inclusive Framework members. In this regard, I want to emphasize the role that developing countries have had in the negotiations. Many of the terms of both the political agreement and the content of the rules that have been negotiated since respond to input from the large developing country membership in the Inclusive Framework. This includes, for example, low thresholds to establish the nexus for the taxing right, the inclusion of an elective process for dispute resolution, as well as revenue sourcing rules and rules relating to the elimination of double taxation that prioritize low capacity and developing countries. For Pillar 2, the minimum tax, or GLOBE, the GLOBE rules as we call them, the rules and the commentary have been agreed and published by the Inclusive Framework. The Inclusive Framework is now developing an implementation framework to ensure consistent administration. In a nutshell, the GLOBE rules will ensure that all large multinational enterprises, those with annual revenues of at least 750 million euros, will pay at least a 15% effective tax rate in each jurisdiction they operate in. There's a carve-out for substantial activities that protects the ability of countries to offer low rates for real investments by M&Es in labor and tangible assets in the country. The GLOBE rules are what the inclusive framework call a common approach. And that means that not all members of the inclusive framework are obliged to implement them. However, even where a country does not implement the GLOBE rules, or is not even a member of the inclusive framework, the rules will have an impact in the country if an MNE that is subject to the rules in another jurisdiction has operations in that country. Put simply, if there is income in a jurisdiction that is taxed below an effective rate of 15%, then the difference will be taxed somewhere. In these cases, it's important to remember that source countries always have the ability to tax that amount first, rather than give up the tax to another country. Now, not only have these rules been finalized, but many countries are right now working actively to bring them into effect. In Europe, there is a work to agree an EU directive, which would apply to all EU countries. But even if the required unanimity to achieve that directive cannot be reached, Germany, France, Italy, Spain, and the Netherlands have all announced that they will introduce the rules on their own. Switzerland is amending its constitution to accommodate the GLOBE rules. Elsewhere, Canada, the UAE, Australia, Singapore, Japan, UK, and others are also working to bring the rules in. The way the GLOBE rules operate, once a critical mass of countries subjected their MNEs to the minimum tax, there will be a strong incentive for other countries to also implement, so as not to risk giving up tax to other jurisdictions. Now, what this does is it puts a spotlight on the question of tax incentives and the design of domestic tax policy. Where a country is provided low taxation below the minimum effective rate of 15% to attract investment, then the income on that investment will be taxed at the minimum rate somewhere. And it's worth repeating that the source country always has the right to tax first. Therefore, this is a major opportunity for countries, particularly developing countries, to re-examine their domestic tax policies and see where they may collect additional revenues without sacrificing their ability to attract foreign investment. We estimate that there is at least $150 billion of additional tax revenue at stake. And with the push by many countries to implement, this is by no means a theoretical exercise. There is real money at stake. Now, there's also a strong commitment from the inclusive framework and the international community more generally to support capacity building in developing countries to make sure they can benefit from the two-pillar solution and the international tax standards more generally. The OECD has been providing multilateral support through, for example, the regional consultations, the Manila event that I mentioned earlier, but also around the world, as well as a range of training and learning resources on all aspects of the new rules. One of the important rules, particularly with respect to Pillar 2, is a new report on tax incentives and the global minimum corporate tax, which presents concrete considerations for emerging and developing countries to consider as they prepare for instant implementation. This report, which was delivered to the G20 in just this month, builds on previous work by the OECD in this area and focuses on the need to reassess tax incentives in light of Pillar 2 and offers a number of considerations for policymakers, particularly in developing countries. Complementing this, the OECD is gearing up to provide bilateral support to work with developing countries one-on-one to analyze the impact of the global minimum tax and how it interacts with their domestic tax rules, and particularly on tax incentives. We are working on pilot programs in 8 countries right now, and we aim to roll out support more widely in 2023. Now, each of the pillars is about international cooperation and will rely on a consistent and coherent administration of common rules across many jurisdictions. For example, in Amount A, the Inclusive Framework has just released a consultation document on tax certainty and administration to seek the views of public stakeholders. The process for determining Amount A and for preventing and resolving disputes on both tax rights that are allocated over the profits of an M&E and the jurisdictions that will have to cede taxing rights as a result may implicate 100 jurisdictions or more. So it's necessary to have a system that is both efficient and effective and takes into account the concerns and the input of all jurisdictions that are affected. Amount B as well provides a new approach to the application of the arm's length principle in certain cases. And so the administration of that will be vital to ensure consistent and appropriate application. For Pillar 2, the new rules for the global minimum tax, again, this is something where the same rules will apply over many, many jurisdictions where M&Es operate. The inclusive framework is working now to develop an implementation framework that will provide for the consistent administration of the rules, as well as guidance for administrations on the possibility of safe harbors that can simplify administration, guidance, and rules that will allow tax administrations across many jurisdictions to apply the rules consistently. Now, I want to mention one other issue before I close. Just recently on 10 October, the OECD delivered a new global tax transparency framework to provide for the reporting and exchange of information with respect to crypto assets. The new transparency initiative comes against the backdrop of a rapid adoption of the use of crypto assets for a wide range of investment and financial uses. Unlike traditional products, crypto assets can be transferred and held without the intervention of a traditional financial intermediary, such as a bank, and without any central administrator having full visibility on either the transactions carried out or on crypto asset holdings. The crypto market has also given rise to new intermediaries and service providers, such as crypto asset exchanges and wallet providers, many of which currently remain unregulated. These developments mean that crypto assets and related transactions are not comprehensively covered by the OECD G20 Common Reporting Standard, which we use for the exchange of financial account information. This increases the likelihood of their use for tax evasion while undermining the progress made in tax transparency through the adoption of the CRS. The crypto asset reporting framework will ensure transparency with respect to crypto asset transactions through automatically exchanging such information with the jurisdictions of residence of taxpayers on an annual basis in a standardized manner similar to the CRS, and which applies in respect of financial accounts. This is another example of how the institutional frameworks that have been developed in the international tax space are able to respond to new emerging issues that have global implications and for which individual countries acting on their own are unable to address effectively. There are many other issues that the OECD is working on, and I think this workshop is a terrific opportunity to examine the full range of new ideas in the international tax space. Thank you very much for the opportunity today, and again to ESCAP for organizing this event. I wish you a good seminar.
So unfortunately, we don't have Andrew today to respond to questions. I believe there would be a number of questions regarding the progress of the two-pillar solution and also the new emerging issues such as the cryptocurrency challenge. So I think, as Andrew has highlighted, that even for multilateral framework, some pilot countries may generate further momentum for the initiative, and also the international multilateral system is responding to emerging challenges as well. So in parallel to the OECD G20 and inclusive framework, the United Nations also provides another global platform for tax debate and policy discussion. And within the UN system, the unit led by our next speaker, Michael Nannard, who is currently the chief of the International Tax Cooperation Unit, is coordinating the global discussion under the UN umbrella on international taxation issues. And also he supports the work of the UN Tax Committee, the Committee of Experts on Tax Matters, in their effort to better support developing countries, in particular on international taxation issues. So, Michael, we are very much delighted to have you here, and thank you so much for rising so early on your holiday. I think it's 3 or 4 p.m. at your local time, and we are very much honored to have you here. So we're look forward to hear your insights, introduction of the UN new Article 12B, and also your insights on the ongoing international cooperation on taxing the digital economy. So the floor is yours, Michael.
Thank you. I'll just check you can hear me after a few technical issues.
Yeah, we can hear you like very good.
That's
yeah.
Good. I've gone back to old-fashioned wired headphones. First of all, yes, it's almost 4:30 in the morning here, so I'm suffering some of this sleep deprivation that I know so many of you do at our events and OECD events. So I'm very glad to do it for this very important event, and I congratulate you and Hamza and colleagues on it. So if we start the slides, I'm just going to take you through a little bit of the background to the to the UN digital work, and then talk specifically about Article 12B, which is the most recent aspects. So that's me, and if we go to the next slide, I'll just mention the UN Tax Committee briefly, because the committee is the body which created Article 12B and which I lead the secretariat to. It's a body which has a membership of 25, nominated by countries, but chosen in their personal capacity. The current committee is in place to the end of June 2025. They have 4-year terms. They meet twice a year, but they have a lot of subcommittee meetings, and we have representatives from other countries and also from industry, from academia, from civil society who participate in many of those subcommittees. And that's the web page at the bottom. And if you go to that, you can get all the publications, and you can see we just had last week a meeting in Geneva, the 25th session, including some outcomes on digital, which I'll mention, and the papers are all there. And I think it's a very good page to look at. If we go to the next slide, this is just to show you the makeup of the current membership, and you'll see from your part of the world we have a diverse representation and more generally a diverse representation. Now, what you'll notice is developing country experts are very much in the numerical majority, which I think has led to things like Article 12B, because it's a body where developing countries have the majority. If there's a difference of view, and on many of these issues there are very distinct differing views, so it's important for developing countries to be in fora where they really can move things along and can really be the decision makers. If we move to the next slide. This is very quickly, I'll take you through the mandate. It's a very, very broad mandate. It includes taxation of the digitalised and globalised economy at the moment. There's a subcommittee specifically on that. I'll talk about that later. As you'll see, very broad, including looking at new and emerging issues. And if we turn to the next slide, we'll see what I think is the most important part of that mandate, apart from its breadth. And this is the 5. Give special attention to developing countries and countries with economies in transition. That's a sort of a historical post fall of the Berlin Wall reference, the second one. But the first one shows that the emphasis of the committee should be on what works for developing countries and what the priorities and the needs of developing countries are. And ultimately we learn that from you. If we turn to the next slide, UN Model Convention, the 2021 version, is available online in English at the moment. It will soon be available in some other languages. And the basic difference, many of you will know this if you're treaty negotiators, is the basic difference to the OECD model. There are a lot of similarities between the two. Sometimes they've learned from us, often we've learned from them. And sometimes on offshore indirect investments, we've each taken a slightly different turn in a provision that really started with the UN, and now both the UN and the OECD have the same provision. What your issue is that both countries usually have both taxing rights based on both residence and source. But in any country, if one country is taxing based on residence and one country is taxing on source in a relationship, quite legitimately under their domestic laws, you need to somehow deal with that double taxation. And it means that one country or the other has to yield in terms of giving a credit if it's a residence country or not taxing if you're a source country. And developing countries particularly tend to be capital importers, source countries, as we refer to them. And so the issue is which country gives up its taxing rights. And in the UN model, the source country gives up its taxing rights less often than it does under the OECD model in general. The other thing is the UN model strongly favours withholding tax mechanisms. In fact, there was a submission by the tax committee to BEPS very early on to the inclusive framework, I think, or no, technically to the OECD Secretariat, saying you should be looking at withholding taxes. And the BEPS work didn't really examine the issues of the legitimacy of withholding taxes and how they can be made to work better. And even now, the issue of withholding taxes, many of you know, is a big issue within BEPS, how it fits in some of the formulae. So if we turn to the next slide, this is about the UN response to the digitalised economy. And this is Article 12B, which is a provision which allows, in the bilateral treaty, allows for taxation by the source country, by the place, in this case, where payment is made, the place where effectively where the service is delivered, and then payment is made for that from one of your people. So Article 12B is Article 12B because there was already an existing Article 12A, and Article 12A is on fees for technical services. Many of you have a fees for technical services article in your treaties. Very important for a lot of developing countries. And what that did was that broke the link with the permanent establishment requirement. If you look at the discussion on services in the OECD model, it says, well, there were variations between OECD countries about whether services were special and whether there might be a different requirement before you could tax. But if you didn't have any physical presence in the country, the OECD, at least at that stage, members were unanimous that you didn't get a taxing right if you were the country where these services were delivered without any physical presence. And the UN took a different approach in 12A. It said the concept of permanent establishment is really outdated in the modern world, at least when you're dealing with fees for technical services, which includes consultancies, the sort of the tailored provisions. So 12A was an important step forward. Took many years to negotiate. It was hard fought, and again, it was developing countries to push that, especially within the committee. Again, in the committee, there is this developing country preponderance, which means that these provisions, which are now quite important, 12A, in a lot of countries' models, can be put into the UN model, which assists you in your negotiations and can also help to make sure that they're as similar as possible across the models of countries. So 12B is a provision on automated digital services. It's as I said, 12A was really about the sort of the more tailored services such as consultancies. 12B is the sort of the less tailored services which might be provided. I'll come to some examples shortly. And in dealing with that, this provision, first of all, preserves source country taxing rights. You do have taxing rights over these sorts of activities at domestic law if it's in your law. Sometimes there's a suggestion that there's no taxing right allowed at domestic law unless it's gifted to you by a treaty, a multilateral treaty such as Pillar 1. But in actual fact, at domestic law, you have a right to have such a tax if you want to, subject to your own constitution. And the question is, how you deal with that in a bilateral relationship, in a multilateral relationship to avoid double taxation. Do you give up that taxing right, or does the resident state give a credit or exemption to effectively allow that to be preserved? So the second aspect of that is you do need a domestic law before you have 12B applying. It doesn't have to exactly track the terms of 12B, but a lot of digital services taxes and other taxes, the 12B would allow them to be preserved to the extent that the terms of 12B were met. And we'll see that the 12B is quite broad. It recognises the importance of withholding taxes as a gross taxation system, but it doesn't actually say it has to be a withholding tax. It tries to be as simplified as possible. This is a big issue for a lot of developing countries, and therefore it has a few areas where you might think, well, that's not perfect. Maybe they could have done something else, not just relied on payment as the definition of source, but maybe they could have looked at where a service was used. And they looked at that, and I think ATAF in Africa thought that it was possible to have either of those being the source, but the committee thought that for simplification, the main problem was where payments were being made from your countries, and it was very difficult to track usage, so that they thought at the moment that it was imperfect, but the benefit of simplicity was important. And very, very importantly, there's no linkage of this provision to mandatory binding. That's one of the big issues internationally. Until we get a mandatory binding dispute settlement provision that you in developing countries can have confidence in, that will be as fair to you as it is to developed countries and to big business, then I think there's, particularly with your experience of investment treaty arbitration, a lot of developing countries are very, very wary about that. So the UN one is not linked to that. There is a potential provision in the UN model for countries that want mandatory binding arbitration, but it's not a required part of this provision. So that's quite different to Pillar 1. And you might think, why is the UN doing this when Pillar 1 is out there? And the view we've always taken, I think history is proving this was the correct view, is, first of all, a lot of your region are not members of the inclusive framework. So we can't assume that every country in the world is following that work. Secondly, some members of the inclusive framework have not even agreed to the executive statement. I think Pakistan and Sri Lanka from your region, as well as Nigeria and Kenya, have said, well, we don't actually agree with the statement in October. The other thing was that the statement in October 2021 was an executive statement. It wasn't a treaty. And you can't assume that as a matter of sovereignty that every country will join up to a treaty that might encapsulate the terms of the October 2021 agreement, which was so broad anyway. There's still a lot of very, very important issues which are undetermined. That's not to criticise the OECD. But what the committee decided is there might be a whole lot of reasons why a country doesn't join up to the Pillar 1 mechanism. But maybe the Pillar 1 mechanism might not even come into force. You know, if some big countries don't join it, that's one of the issues at the moment. It may not have sufficient numbers of resident state countries to come into force internationally, depending on the terms of it. That's what some authors have been looking at in particular. And again, that's not to criticise the OECD. It's just to say we don't know what's happening with Pillar 1, and that's why the committee said, with no disrespect to the OECD, there are all sorts of reasons why countries might not join up to Pillar 1, or Pillar 1 might not be applicable to them. So let's look at something as an alternative in the bilateral environment. So if we move to the next slide, if we go to the next slide, we'll see there we go. Thank you. And the reasons are the reasons you would know why countries in the committee, or people in the committee from countries but not representing them, wanted to look at what we could do in bilateral treaties to try to deal with this issue of very valuable automated digital service being provided to countries and great profits being made, but the profits not being taxable because of old-fashioned PE requirements that really were very based in a very different world. So this is the reasoning, which you'll see in the commentary. It's very important to look at the commentary of Article 12B. You'll find that in the model, which I pointed you to. It's free. The model can be freely downloaded, and it's quite a detailed commentary, including the criticisms from those who didn't like Article 12B. One of the features of the committee is that we can't get an agreement, then we actually mention the reasons why the members who didn't like a provision didn't like it in the commentary. The provision is still there, but there's discussion about it in the commentary, and sometimes some alternative provisions where there's some things that they don't like and suggest alternatives. I think that's a good model in an area where there's not a lot of agreement to have both sides put, and that means that will also help you in your negotiations to have a sense of what the arguments you will meet against Article 12B are and how to respond to them. So if we move to the next slide. So the general scheme of Article 12B, and you'll see all the detail of it in the model which is available, is that it allows income from automated digital services. I'll talk a little bit more about what they are in a minute, arising in a contracting state and paid to a resident of the other contracting state to be taxed in the contracting state in which it arises, as a rate to be established through negotiations. Now, it also, like a lot of UN provisions, it allows the resident state of the provider to tax it as well. But then by allowing the source state to preserve their domestic legislation and to tax it at a rate which is agreed, then it is actually, as I mentioned before, it's allowing a taxation right to be preserved, which would not be preserved under the OECD model, for example. And it recommends a reasonable rate of 3 to 4%. And also, for the first time, it has a profit-based option at the taxpayer election. And what the profit-based option is, I had to write this down because it's quite tricky. And if you look at it, it's in paragraph 3 of the article. So what happens is you look for the profitability ratio of the automated digital services business of the taxpayer, the one who's asked for the profit-based election. Then you apply that profitability ratio to their gross annual revenue from your country, which makes sense. Then you take a sum which is 30% of that, And you might say, why is there a 30% sum? And then this is another example where there's an attempt to be fair to all countries. That some of you know the Massachusetts formula for cost allocation, where it's divided evenly into payroll, into assets, and into sales. So the 30% sort of reflects sales, not quite 33 1/3% as it should be, the sales aspect. Then you apply the applicable taxation rate under your domestic law to that amount. So it's meant to be simple. It's not meant to be too grounded in exact philosophical purity. If we go to the next slide, automated services, digital services, any service provided on the internet or another electronic network, in either case requiring minimal human involvement. So the key point is minimal human involvement. If we go from the service provider, that is. If we go to the next slide, you'll see some examples of what that means, which is in the article itself. They still have to go through that basic test of the minimal human involvement. And one of the tests that is mentioned in the commentary is that if new consumers come to the digital service provider and seek that service, does it involve any extra work, or are they basically already got everything sorted, the network and so forth? So you'll see there's a list of the things which are covered. It's quite broad, including online gaming, but also particularly on advertising. Doesn't apply if the royalties provision applies or the fees for technical services provision applies, which is Article 12A. You'll often find a fees for technical services type provision in the royalties provision in some of your treaties. If we go to the next slide, these are some of the things the commentary says are not in automated digital services, and you see a lot of them are relating to the customised services, which some customised services, like the first one, customised professional services, maybe come under fees for technical services in 12A if you have the domestic legislation and 12A or an equivalent in your treaty, and certain other things which are really not the online sale of goods and services and other than automated digital services and revenues from the sale of a physical good, which are where you've got the Internet of Things, for example. They're not seen as sufficiently a sale of the automated digital service itself. So if we move to the next, and all of this is discussed in the commentary, which I would recommend you look at. If we go to the next slide. So the next step is countries need some sort of legislation, either already having it or putting it in place, before it's really probably in their interest to negotiate on Article 12B. They might negotiate on if they think they're going to have something soon, including a digital services tax of some sort. We don't know how successful 12B is going to be in practice because it's still early days. Countries need to have their legislation in place. And as you know, the bilateral negotiations are usually secret until you get a treaty signed, which takes some time usually. So it's a little early to tell how effective it's going to be. People who say it's not effective because there aren't treaties with it in it, it's too early for there to be treaties with 12B in at the moment. But let's see what happens in the next few years. Most of the research, including from Martin Hearson recently, suggests that 12A, since it went into the UN model, has become more and more popular. And you certainly should look at having a 12A in your treaties if you don't. So the next steps, the UN Tax Committee is looking at a possible fast-track instrument to support wider adoption of Article 12B to make it easier for you, a bit like the OECD multilateral instrument, to get a lot of your treaties updated in quick time. especially important for you with a lot of with a lot of treaties. There'll probably be other options in such a fast-track instrument, including Article 12A, as I mentioned. Maybe the UN subject-to-tax rule, which is being negotiated at the moment, expected to be finalised in this membership, and it'll be a broader subject-to-tax rule than under the OECD one, and maybe something like offshore indirect transfers under Article 13, which I've mentioned, which is a big issue for a lot of people in your area. So if we move to the next slide, which I think is the last one. The other work streams are work stream B, the broad issue of physical residence requirement. This is an important issue. Do you need physical residence, a physical presence in a PE test or not? Should we move away from that? But it's also an area where there's distinct differences, which often are largely along developed and developing country lines. There's no doubt that in this area, a lot of differences are broadly along developed because they're seen as either favouring capital exporter or capital importer countries, residence countries or source countries. Workstream C has just agreed to do some preliminary work last week about possible issues of remote so-called nomad workers for developing countries, to take a developing country perspective and say, what's happening to our tax base as a result of this? Are there opportunities for us, and are there also risks, and how do we deal with that? So they'll put a paper to the next session of the committee in March and decide whether there's an opportunity for the UN to give guidance in this area. The UN Tax Committee only gives guidance. You're not required to follow it, but it is tends to be good quality guidance. There's guidance in so many areas. Have a look at our publications. You'll see that extractives, now the environment, all sorts of important areas. Negotiation of tax treaties. We've got a manual on that. So have a look at all the publications are free and freely available if you go to that site I mentioned, and then look for the publications. And then finally, another big thing is UN capacity development in this area. In September, we had about 150 developing country and other people participate in a workshop which looked at all the issues from bilateral, multilateral, regional, and unilateral actions. And we had some of the speakers such as Wei Sui that you've heard. So that's an important area, and there'll be more and more capacity development, not just to help you in dealing with these issues in implementing laws, but also in participating in international forums such as the Inclusive Framework to help make sure that you're as effective as possible when you're in an international environment, UN, or regional, to make sure that your country's interests can be put forward. Thank you very much.
Thank you very much, Michael, for your excellent presentation and introduction of the very important work which has been done over the years by the UN Tax Committee. I think, as you mentioned, that capacity building is very important, for countries, especially countries currently not directly involved in the major international norm setting processes. I think that this would be very helpful. So may I just quickly open the floor for questions? So you can raise your hand in the Teams, and if you have any question relating to the UN's work on the taxing the digital economy regarding the new Article 12B and also the Article 12A, as Michael has introduced. Yes, Rachel, please go ahead.
I couldn't let this opportunity pass. Michael, I think one thing that needs to be clarified, especially with the attendees, is this a zero-sum game between Pillar 1 and Article 12B? I mean, is it either or can you have both? I think that needs to be sort of explained to the attendees here, who may not understand the entire concept of it all and how it works together.
That's an excellent question.
Yeah, it's Michael, a good question. I think if a country joins up with Pillar 1, then the likelihood is part of that deal will be that something like 12B is not allowed to continue because the underlying legislation would not be allowed to continue, at least in respect of other participants in Pillar 1. But since we don't know who will join Pillar 1, who the other participants in Pillar 1 are, you could, I think, actually join Pillar 1. I'm not sure whether you would be. Yes, I would imagine you could apply it in respect of non-Pillar 1 ratificants, but that's something you have to think about. But the important thing is that a lot of countries felt that they may not join Pillar 1. We don't know what Pillar 1 will look like eventually at the moment either. So I think it's a zero-sum game in that there will be clear in Pillar 1 that as for participants in Pillar 1, you can't have DSTs or other, I think, some other relevant provisions or something like that, which is still a largely undefined term. But yes, I think you have to expect that if you joined up with Pillar 1, then probably not just this provision, but the underlying legislation would not operate in respect of those other countries. So I hope that makes sense. It is a good question.
Thank you, Michael.
The calculus of those who drafted this is that it still is likely to have an important role in other cases, and again, because we don't know who's going to join up to Pillar 1, we can't even be sure it's going to come into force.
So I see no question from the floor at the moment. So may I just take the opportunity to also ask a question to you? So like in your view, and also from the discussion at the UN Tax Committee, if we think from the shoes of developing countries, especially developing countries not yet joined the two-pillar initiative, what are the most attractive features of the UN framework for them, for developing countries? And what are if they had there's any reservation, what are the major reservations regarding Article 12A and B?
Yeah, the first one is that, and there's some very good work in the South Centre, which actually does their view of the revenue returns from 12B compared to Pillar 1, and it comes up very, very well actually, particularly at the 4% level. I have a look at that. That's not our analysis, and I'm always a little bit suspicious of analyses of all these types of agreements. It's something we have to get more sophisticated at. But the advantages are it allows for withholding tax. It affirms the importance of withholding tax as very important to developing countries. It's not linked to mandatory binding arbitration, and it's a fair outcome, which is a fair outcome to business as well, which is not over complex and administrable. Now, the downsides are you have to negotiate it in a treaty. If you have a treaty, if you have domestic law, which maybe draws upon Article 12B, then if you don't have a treaty, then you have the risk of double taxation, but the other country can't complain that it is contrary to a treaty. Now, you can still get into the trade issues of the threat of blacklisting, the threat of Section 301, and I thought Professor Sway did a really good job in pointing out that there's unilateralism on the trade side as well as the tax side. Why are we just condemning unilateral tax activity? So I think those are the main ones. It has to be negotiated. That won't be easy, but people said that about fees for technical services, and more countries are getting them into their ambit. The final thing I'll mention is the Pillar 1, without criticising another body's work. On the one hand, you have Amount A companies where there's some amount, and A lot of countries think it's not much. Nigeria has been quite public on that, which would come to you under Amount A. But you also have got to remember under Pillar 1 that for all the other companies, you're basically back in the old-fashioned PE rules because you're not allowed to apply a digital service tax. So in working out the analysis of Pillar 1 for yourself, you don't just look at the Amount A companies, look at the fact that you won't be able to apply a DST for all the other companies you deal with. And I think Nigeria said it has about 6 Amount A companies, and it would lose all the revenue from the other companies which it applies its digital taxation to. So those are some of the things you have to look at. And there's no easy answer, but we hope that we, the UN, and hopefully others, including the OECD, can help you further that analysis. And I think we did that with our capacity building in September, and that's something we need to do further. Thank you.
Thank you very much, Michael. Okay, I see no further questions. So that means that we can now release you in the very early morning. And thank you so much for always supporting the tax discussion in the Asia Pacific region. And we are really grateful for the support from DESA, and we look forward to continue to work with you. And hopefully also be your arm in the region, like the arm of your department, your team in the region to reach out to our countries. Thank you very much.
I am Australian, so I sort of feel part of the region for that reason alone. Yeah. Thank you. Bye.
Great. Thank you. So with that presentation, I think it's an excellent opportunity now for us to hear from our next speaker, Professor Craig Aliff, who is the Professor of Taxation Law in the University of Auckland. So Professor Aliff, his research area are in the fields of international tax, corporate tax, and tax avoidance. And before joining the academia, Craig has 14 years of experience as a tax partner at the KPMG and 9 years as a tax partner at Chapman Tripp. So he also published extensively on the tax subject, including the recent book on taxing the digital economy, theory, policy, and practice. So which is exactly the same focus of our workshop today. Craig is also working with ESCAP to develop a practical manual on what are the options on the table for developing countries and the relative pros and cons of each option, as well as the pragmatic considerations for countries to consider some of the options. So we are very delighted to have you here, Craig. So the floor is yours.
Thank you very much, Zhang. Now I'm just in the process of getting my slides organized, so please just bear with me for a second. Good. Now I'm hoping you can see the slides.
Yeah, very clearly.
Oh, fantastic. Well, good morning, good afternoon, good evening to everyone. My topic today is to look at taxing the digital economy and the pros and cons of different approaches, and really what's in it for source and market countries. Now, I'm actually going to tackle that in reverse order, in the sense that I'm going to step back and get us to look at the bigger picture here, and that is sort of like the wider perspective. And actually, some of the previous speakers have already talked about this. And then when we're looking at the pros and cons, I have to sort of declare a spoiler alert right at the outset. That there are, in fact, a lot of pros and cons to different approaches, and there are, at this point in time, as many questions as there are answers. I wonder if I can ask the delegates, please, just to turn off your microphones, just so that I'm not competing with you. So let's just look at the order of what we're going to look at. We're going to look at firstly justifying source taxation in the digital age. It's what Klaus Vogel described as the forgotten question, and often we sort of proceed on a basis of international tax having a whole set of defined rules, but sometimes it's good to step back and really think about, well, actually, are we entitled to tax source transactions? What's the value of our marketplace, and should profits be attributable to it? And then we're going to briefly look at the contributions that source countries make to digital businesses. So again, focusing on the digital revolution, really, and the contribution that all countries, whether they're developing or developed, make to the profitability of these enormous digital businesses. Then we're going to look at the problems with the existing international tax rules and the options of how we will go about in an as yet undefined way, the various options that some of the speakers have spoken about already this morning, and consider the advantages and disadvantages of them. So let's just look at a little bit of theory. Sorry to bore you with this, but it is actually quite important when you think about the different bases of residence and source. And the two major principles of theoretical taxation are based on the benefit theory, which has a worldview that the taxpayer and our government are seen as economic actors who exchange consideration with each other. In other words, the taxpayer pays tax because it gets something from the country, and the country receives that tax because it provides things to the taxpayer. And so the benefit theory is closely aligned, in my view, with source taxation, and it can be justified on that basis, as we shall see in the next slide. The major alternative theory is the ability to pay theory, and when you think about how that operates, it's very much aligned to the idea of progressive taxation. You need to have an understanding of the total income of your resident taxpayer, which is usually only known by a country of residence. Occasionally, you can do it on the basis of citizenship, but largely you do not know what your non-residents earn outside of your country. You only know what your non-residents earn inside your country, and so therefore the ability to pay theory is really very much a product of residence-based taxation, and doesn't really have anything of the reciprocal nature that source taxation has, in the sense of economic actors exchanging consideration with each other. It's simply a mandated obligation, or perhaps a contribution to citizenship as well. Klaus Vogel, the great German academic on international tax, has pointed to some really interesting early 19th century German studies, and they trace a long history. He calls it the Renaissance of the benefit theory, who have argued, or these German philosophers or theorists argued, that the right to tax is linked to the economic environment provided by the source state. And so what Michael Leonard was talking about, he said, don't assume that that your state doesn't have the right to tax under Article 12b. In fact, it does. If there will be justification for that, and the legal right to do it, if it's granted to you by constitutional legislative amendment. So that's definitely the proposition, and I support exactly what Michael was saying. So what do source countries contribute to digital businesses? Well, A lot is a short answer. They contribute the business environment and the economy, confidence, law and order, the actual ability of consumers to be able to afford the products. They contribute the technological infrastructure, which is suitable communications, Wi-Fi, broadband, and a population that actually can afford and hold and use those devices. It contributes the legal system, which might uphold intellectual property rights, but would certainly have the ability to enforce contractual obligations, the ability to deal with fraudulent and criminal behaviour and consumer problems. It has infrastructure, which we often would underestimate, but in actual fact, if you think about purchasing a computer through the internet, it has to come through the supply chains, be that at the airport or the port, be delivered along a physical road, come to your house, be unwrapped, the disposal of the packaging take place and these are all contributions that are being made by the source state. And then lastly, and this is perhaps unusually the case with multi-sided platforms, you contribute users for a digital business. And in the case of social media, the users will both design and provide content, certainly contribute family and friends to the network effect, the group of people that are part of the contributing users. And in the case of shared economy, this might actually involve providing physical assets or physically performing the services such as Uber drivers or Airbnb hosts. And then, of course, don't forget that the reviews, your TripAdvisor reviews, your validation and assessment and quality assessments on various goods and services are all part of what consumers, what the source state provides. So quite a significant benefit being provided in these situations. Now let's turn from this assessment of the source state and the right to tax to the problems that we know currently exist with the international tax rules. And I put it to you that there were, or there are, in fact, none of these have yet been removed, but many of them have been attempted to be tackled. But there are 7 major problems, 7 challenges, if you like, with the existing international tax rules. The first 4 of these are probably mostly to do with the digital economy. And they include, of course, the big one, the big problem area of Action 1, which has caused us all to be here in this interface, and that is the vanishing ability to tax business profits. A twofold problem, the way that digital companies could do business of a significant size without establishing a taxable nexus. So that means they didn't have a permanent establishment, they didn't have a physical presence, and then there's a second closely associated problem, and that is that even if you did have a physical nexus, how much profit would you allocate to it? And so those 2 components put together make that, it was almost the nut that couldn't be cracked by BEPS 1.0. It needed to be expanded and then put into BEPS 2.0 in order to for the OECD and the inclusive framework and the work of the digital task force to get a good understanding of what the issues were and how they could be addressed. The other top 3 of those digital points, I'll just comment very briefly. We're concerned with the use of data, the contribution of users and measurement of value. Goodness me, how do you say that what's the value that you ascribe to pictures of cats on social media websites? And it's, of course, it's not the pictures of the cats that are important. It's the fact that you've got a group of network which are looking at those pictures and thinking that they're valuable and providing a very valuable base for advertisers. The reliance and mobility of intellectual property. Well, did we ever discover that intellectual property could be hosted sensibly, mostly by large multinationals in jurisdictions which didn't really have any previous tax base, or indeed any tax or a great deal of connection to the creation of that intellectual property, and so many of the structures that caused the problems that generated the BEPS 1.0 and then subsequently 2.0 problems have had a heavy reliance on both intellectual property and its mobility and ease of being able to be transferred. The characterization of transactions and income, just very quickly, these are complex. Should something be dealt with as business profits? Should it be dealt with as royalties? Should it, even in the case of an influencer, be something that is dealt with under Article 17 as part of entertainment? And then the three more traditional problems, I think, which are sitting in the 1920s compromise, the failure of transfer pricing to deal with certain multinational enterprises and transactions, the inadequacy of residence-based taxation, and the competition by states. Now, I will just make the point, as we start to look at, what are the alternatives and what are the solutions. I think one of the options involving the multilateral compromise or the multilateral solution is the fact that it actually does deal largely with all 7 points of these problems. In other words, it's not just focused on purely the problems of the digital economy. It does go broader, and in that sense, there is some point and merit to be thinking about that. Now, I'm just going to hopefully get my next slide. Good. So there are the problems, and there are the challenges that we have. So what now are our options? And you've heard from the OECD about the multilateral solution. And you've heard from Michael Leonard about the withholding taxes, and whether that be on a, as he was contemplating, a bilateral basis, but perhaps there's an opportunity to think about multilateral arrangements for that. And Wei, Professor Wei, was talking about digital services taxes, seeing them different from withholding taxes because they were excise tax based, primarily targeted at users in the digital economy. So quite a targeted digital service tax. So these three options are sort of to do with taxing the multinational corporates themselves. The fourth one, VAT on the digital economy, has a different tax base. It's the consumer base, because these are our customers, and imposing VAT on those customers I see as being different from the corporate base. Ideally, both should be taxed, both the corporate base, the profits of the multinational, and the consumption taking place, and both should be subject to tax. So now I hope you can see this, and you may have previously seen this, but I thought I would include it. I did think long and hard as to whether I would, but it's because often I think Amount A is seen as very complicated and complex and hard to describe and understand, and I think that's right. But this slide to me explains how Amount A works. And if you understand that already, then I apologize. But what it's doing is it's looking at the whole of the multinational company's profitability. It's then using a transfer pricing technique to split out routine and residual profits. And the routine profits are amounts that would ordinarily be paid to parties who using outsourcing methodology. So they're just sort of standard amounts of profitability. They don't capture, for instance, some of the synergies of supply chain or some of the intellectual property profitability. Those are found in the residual profits. And then the split of the residual profit takes place, some of which is going to the market jurisdiction and some of which is retained by the residents multinational. The reason why I show you this in the context of Amount A is that the formulas in Amount A are a much simplified version of this pie chart. And it's simplified in the sense that for very large companies, the excess profits greater than 10% are regarded as the residual profits, and it's really they're a proxy for those residual profits. And so in some of the analysis that I think Michael was talking about, and indeed Wei was talking about as well too, that when you are dealing with large corporate entities, the residual profits are not necessarily the economic rents which are being which are being derived by the multinational when you look at it as a whole. My point about the fact that when you come to look at the 2020s compromise, which is the multilateral solution, that it deals through the various pillars, pillar 1 and pillar 2, it deals with all of these problems. Now, I'm not going to go, I don't have time, unfortunately, to go through all of this analysis in detail, but you will have the slides and you can see the comments there. Effectively, what I'm suggesting to you is that all of these 7 points are in some way or another addressed by either pillar 1, Amount A, or Amount B, or pillar 2. And that's one reason not to quickly dismiss the inclusive frameworks work, because it is a much more comprehensive. It's not targeted necessarily at the digital economy. It goes broader. It looks at some of the issues to do with residents. It goes broader to the issue of competition by states, and looks at some of the deficiencies in transfer pricing. So in many respects, there is a sort of holistic feel to the multilateral solution, which is, if you like, more comprehensive and more fundamental on a not particularly digital company basis. So advantages and disadvantages of various options. Well, as I highlighted in my spoiler alert, I'm afraid I have as many questions as answers on the various issues here. And I think it's all just a process that we are definitely sort of keen to understand and work through, and that we should be doing that together, particularly where there are countries that have similar profiles to your country. One thing is very clear: the status quo is completely unacceptable. We have been putting up with a completely and totally unacceptable tax outcome as a result of the burgeoning digital economy. It's got more profitable, more successful, and more invasive and more disruptive to other commercial organizations that don't operate in the same way. But it seems to me that countries have to evaluate the complexity of these new rules, the multilateral rules. The UN solution is without a doubt much simpler. And so true that it's also true that digital services taxes do not have the complexity of calculation. There will be significant compliance costs involved in all of this. And I think it's a case of assessing what are the revenue streams and the risks involved, and you know, some of the revenue streams are tied up with that issue of scope. As it currently stands, the amount A companies have this enormous 20 billion US threshold before they are in that system. So there will be many very successful multinationals, literally thousands, of course, who are trading, perhaps who you would think are large multinationals, but they're not caught by the scope of the rules. There is a significant risk, perhaps, in not being involved, and you might see that as being sort of counterintuitive. But I think when you look at the globe rules, the Pillar 2 rules, then not being part of that might carry with it significant financial potential cost. There are political risks involved, and I would say that they are both global in terms of you know, sort of the cooperation or competition point, but they are also domestic, because largely taxpayers have been very active and very disconcerted by the behaviour of multinationals. If you go back to the beginning of the BEPS project and the parliamentary commissions and inquiries that began some of the concerns. Wake, you talked about the trade war risks with digital services tax. Very interesting, actually. I have to agree with everything that he said, and I know it's controversial, but in my book I analysed the legal risks on from the perspective of the WTO, and agree with his conclusions that that they are overstated. But of course, having a legal WTO risk versus the actual practicality of facing down the imposition of tariffs from a very large country is a more practical risk than perhaps a legal risk. So in summary, then, it's a question of you know, what's in it for larger market economies. They're going to be in a different position from perhaps smaller developing economies, and I'm not sure that there's any single easy solution apart from doing the numbers and thinking about really whether there is still yet some possibility for movement on some of these issues, such as I mentioned, the scope of the multinationals, the $20 billion threshold. That might be illusory to be suggesting, but it would be nice to be thinking that that would move more significantly within a shorter time frame than that already contemplated. Also, the allocation rate of residual profits, 25%. I think many jurisdictions would say that that's not very much. And whilst we're on that theme, it's very interesting to note that those German philosophers that I was talking about from the 19th century actually had a conclusion that 2/3 of the profit should go to the market jurisdiction, which is rather interesting. All of these things, and I think unfortunately I'm out of time, and I don't want to hold up other speakers. But thank you very much for listening, and thank you for the invitation, Zane.
Thank you very much, Craig, for your excellent presentation. I think I share the same feeling as you said in your presentation, that we have more questions than answers at this stage. So this is a super complex issue. So it's very much not just about squeezing a little bit additional revenues from the digital economy. So for the options like you presented on the table, that there are still significant uncertainties in the details of these options, in the ratification process, whether this will become reality or not, and also in the eventual implementation stage. And also there's, of course, we need to take into account of the different local context and the constraint in different countries to make a good judgment about the cost and benefit of the different options. And also, as you highlighted, there's also a time horizon issue, whether we are looking at really low-hanging fruit, quick solutions, we can just get some additional revenue, or we are looking at the more ambitious options to address a bigger scope of the issue, as you mentioned, about tax competition, so on and so forth, in the longer time horizon. Of course, there are also cross-cutting issues, as both you and Professor Cui highlighted, that this is not only a tax problem; it's also linked to trade issues, to economic strategy, and for some bigger countries, it's also concerned to overall economic competitiveness concerns and so on and so forth. So I think this all you have highlighted for your presentation is that this is a very exciting topic, and I hope that we do get some really practical advices for countries and put that in the menu so that policymakers can take to their ministers and decision makers and brief them on the issue in a more efficient and effective way. Exactly. So let me open the floor to the participants. So I see one hand from Shujat Ahmed. The floor is yours.
Thank you, Chang, and it was very well fascinating and very well presented points by Professor Craig. My question is regarding the VAT point, which Professor mentioned in his one of the slide, that we should VAT the digital sector. Then how come we apply this in developing countries, for example, in Pakistan, where we have higher number of indirect taxes and sectors are complaining about that? Look, we have indirect taxes, we have indirect duties, we have CDs, we have regulatory duties, we have withholdings, we have GSTs. Then why VAT? And if we have to reform the whole system and transform this to VAT, what should be the starting point? Thank you.
Yeah, it's a great question. Thank you. Well, I guess I'm just making the point that they're simply different tax bases. And so, I mean, you're quite right. Your consumers, if you've got indirect taxes, if they're subject to VATs or GSTs, then you know that they're already being exposed. But of course, there's a competitive element here that you'll probably find your domestic suppliers are having to charge that consumption tax to your consumer marketplace, to the customers in your marketplace, whereas maybe the multinationals are not, and that allows them a competitive advantage which they can make greater profits from. So there is a fairness and an equity issue there, which would suggest that in fact it's right and appropriate for your VAT system to accommodate and require offshore registrants who meet the threshold for your registration threshold for them to register and to charge GST. Now, when we introduced that in New Zealand, it would be fair to say that there was sort of some skepticism as to whether the overseas suppliers would register and whether they would charge and account for GST. I think it would be fair to say that the level of non-compliance is extraordinarily low. They have basically the level of compliance is very high, and the amount of tax that is generated is quite significant. So on the whole, you know, that offshore registration and the requirement and that base is very good, but it probably doesn't necessarily deal with your complaints from your consumers saying that they're feeling they're overtaxed, but I think it highlights that the multinationals shouldn't be able to get away with this tax incidence issue on fairness, and then of course the incidents that they actually need to bear some of that tax themselves on their supplies. Corporate tax, I mean.
Chang, if you allow me to have another point on it, then
sure. Yeah, go ahead. You can have one follow-up question.
Then how should we record transactions in such cases? Because in countries again like Pakistan, we have some freelancers doing the digital services. We have the IT board providing the digital services, and because of this fear, they are not even recording their transactions, and even banks are like, we don't have that transaction record. So what will be the end transaction which should be taxed?
I would suggest this is I would suggest that you talk to either the Australian or the New Zealand revenue authorities, because they both have this, or Singapore. That they're all organised on this, and you are right. Of course, there's a detection, a whole compliance minefield there, but they're not insurmountable problems. Please do not think for a second that they are. But when you're dealing with the hidden economy, of course, you're dealing with a very difficult animal.
Thank you, Craig. I think really excellent questions, and really it touches upon like also the considerations for actual implementation of the like certain options. I think like ESCAP, as Hamza has highlighted in his opening and welcome remarks, that ESCAP is standing ready together with our the headquartered from Michael Nanner's team and our partners to provide like support for countries like on these issues. So we do have some capacity building budget and capacity that we can mobilize like for this purpose. So we look forward to because it has to be demand driven. So we look forward to receiving requests from our member states. So thank you, Craig, again for your excellent presentation. So I think that actually brings us very well to the next presenter to share some of the first-hand experience from frontline policymakers working on the issues of taxing the digital economy and also international taxation cooperation. So our next speaker is Mr. Rasmi Das, who is Joint Secretary in the Foreign Tax and the Tax Research Division of the Central Board of Direct Taxes of India. And he is also a member of the United Nations Tax Committee. So Rasmi, thank you very much for joining us. We have listened to your previous presentations at the global platform and other platforms, so we're very much impressed by the very rich first-hand experience from you. And I hope that your presentation will also benefit our participants today. So the floor is yours.
Thank you, Jeng, and thanks, ESCAP, for inviting me and giving me the platform to share my presentation and share my thought. I must clarify that my views are personal views and do not necessarily represent the views of Government of India. So I think I'm having some problem in sharing my slides. Can the slides be shared from the other side?
Sure. Karine, could you kindly put up the slides for Rasmi? Okay, we have it now.
Thank you. Next one, please. Yes, I think I must apologize to colleagues who might have participated in the earlier workshop of UN in September last month, and also for repeating some of the things which just Michael said and Professor Craig said, because this is something, as last speaker also told, we do not know honestly all the answers to all the questions. So, but we are all exploring those answers. We are in the process of engagement. We are all of us need to try to understand the problem individually and for each of us in each of our countries, I think we are the best person. You are the best person for your country. If you are working in tax policy unit, you know the best. What is for your country is the best one, and there is nothing one size fits all, or there is no perfect solution. And now, just to start the discussion, which I will not be repeating much, but as Professor Craig said, the digitalization has posed direct tax challenges. We all know this. And primarily, though he spoke about 7 points, I think I would like to emphasize only primarily 3 issues on which, of course, others are interlinked. The one is, and I'm only focusing on the problems faced for cross-border allocation of taxing rights. There are domestic issues. I'm not going into that. Domestic tax policy challenges also by digitalization, but I'm not going into that. I'm just focusing on direct tax challenges posed for cross-border allocation of taxing rights. So with digitalization, as has been already spoken to by Professor earlier, we have the nexus rule, Article 5 normally in the tax treaties, which is anchored to physical presence, which is almost obsolete now. Businesses can have business in your country without being physically present. They can provide a service, sell a product, collect the sales proceeds, but they need not be present in your country. So that has the nexus rule has become almost irrelevant. The profit allocation rule based on arm's length principle again has lost its value now, particularly because in the digitalization age, the most important part is the intangible. And these intangibles have no observable location, can be stationed anywhere by the MNEs. And therefore, since under the arm's length principle, most of the profits go to the intangible holder, they can go anywhere. And that policy is unfairly now, again, based on only supply side factors like functions, assets, and risks. It doesn't take into account the role of the market. Ultimately, you don't make profit if your shop is closed. So broadly speaking, as one commentator has said, everything from 1920s is in the museums except the international tax rules, which are framed again in 1920s. And we are, as others are saying, we are in 2020s looking at a new compromise. Next slide, please. Next slide. Now, because of these rules which are no longer relevant or fit for purpose in 21st century, we have a situation where companies do not pay the taxes that they should be paying. The tax rate of Fortune 500 companies is hardly 11.3%. As per various calculations, both OECD and non-OECD countries are losing substantially in their corporate tax revenue. And another part, as you understand from the analysis of the country by country reports, you can see the mismatch. The pre-tax profit to employee ratio in tax havens, in the sense that which are, let us say, low tax jurisdictions, are much less. I mean, that there the profit to employee ratio is close to 1600%, whereas in respect of local farms in the same country, it is hardly 30 to 40%. That shows the extent to which the profit can be shifted just for the purpose of avoiding or not paying the certain level of tax. Next slide, please. Now, this problem actually came into focus after the 2008 financial crisis, where countries suddenly realized that they are not having the adequate revenue and multinational enterprises are not paying their fair share of taxes. That led to discussion, and since then, this topic has been at the center of discussion in the international tax debate. We have, as has been referred to earlier, G20 OECD inclusive framework. Initially, it was G20 OECD, which engaged in the BEPS 1, where the primarily purpose was to find out how to plug the loopholes in the existing rules without changing the rules, where we had an Action 1 report, which identified and admitted there is a problem of nexus, that nexus is not working, but it fought shy of providing a concrete solution, except saying that you can go for equalization levy, you can go for significant economic presence, and you may go for withholding taxes, but within the limitations of the treaties that you have. Then we had the inclusive framework since 2016, and which is engaged in, as we call now, BEPS 2, which now looks at fundamentally changing the rules. The BEPS 1 never sought to change the rules. This BEPS 2 wants to change the rules, and we have the pillar 1, pillar 2, which we'll have a brief look in the next slide. Then simultaneously, the UN, the tax committee, which provides for, sorry, go back to the next slide, back slide, please. Preceding slide, yes, which has recommended, and it's in the model already in the UN double taxation model, that 12B, which is, as has been explained, is relatively simple, provided we have the withholding tax portion of it. And of course, since BEPS 1 and in the absence of a perfect 12B being in the treaties, the countries have expressed their displeasure or their discomfort or disapproval of the existing international tax rules on allocation of taxing rights. And they have gone for several measures which are called unilateral by many, but I call them national tax measures because all tax measures in any case unilateral. These are some of the examples I have given: multinational anti-avoidance law of Australia, diverted profit tax of UK and Australia. Those are to target if you are not having a PE. Specific taxing digital companies which are not paying any tax in your jurisdiction are DSTs by France, UK, and several other European countries. In India, we had our own equalization levy. Then, of course, several countries like India, Nigeria, Israel have tried a wider measure, a significant economic presence, something which the G24 also suggested to the OECD inclusive framework as part of the solution, and which was there mentioned in the Action 1 report, as I said. Then, of course, there is VAT. I think I will come to this little later. While a VAT on cross-border services is perfectly fine and which is recommended by BEPS 1 report, and in India we have implemented it, and I think there were some questions on its enforcement and compliance. I think our experience has been reasonably good. The compliance is really good, mostly voluntary. But what I would suggest is that there is sometimes this narrative. VAT is shown as an alternative to this digital tax, direct tax problems. It is not. VAT is a separate tax base, and it is not a solution to address the direct tax challenges of digitalization economy. And that's what I think Michael Leonard was earlier speaking. He has written on this. I have also written on this. I think developing countries must consider VAT. It's a good thing. I think if they can implement it, it's a good source of revenue, very simple, low-hanging fruit. But they should never buy the argument. And I think it is something which we can discuss later on. I have a strong view on this, that VAT is not a substitute for a direct tax, whether it is through Pillar 1, whether it is through DST, or whether it is through Article 12B, a direct tax, or a proxy for a direct tax. Both coexist, and therefore VAT is no substitute for that. Next slide, please. Yes, broadly, I think I presume that participants are aware of the Pillar 1 and Pillar 2. What I think what has been referred to by Professor Craig also, the Pillar 1 is transformative in its direction. I think we may not like how much we have traveled, but definitely direction of travel is clear. It recognizes market as a factor for allocation of taxing rights. It treats multinational enterprises as a single group. Actually, they are. The treating them separately is actually artificial. They operate as a group, they benefit as a group, so they should be taxed as a group. And it acknowledges limitation of arm's length principle in allocating residual profits, particularly profits where you have intangibles. So these are something substantial change in principles. And whether or not we'll have finally Pillar 1, whether or not it is ratified, as Professor Hedgefield written recently, Pillar 1 is not going away anywhere. These principles will continue to stay, and these principles will continue to inform and affect the international tax rules and practices, which will include, for example, there was some argument that Pillar 1 applies to 20 billion plus revenues. Yes, it does, but the principle doesn't go anywhere. I must say that from India, we have now negotiated with several European countries bilateral APAs where we have got residual profits in respect of marketing activities of the subsidiaries. And that is being accepted across the world. We are also prepared to do that. So those principles of having a residual profit allocating to a marketing and distribution subsidiary or marketing distribution presence, that is something accepted, and that's something the countries can look at, even for companies which are not in Pillar 1, strictly speaking. But its negative part, which is highlighted by all and which we have been always struggling with and asking for more simplicity, is that extremely complex. And also, to start with, it is limited in scope. As I said, in terms of the implementation of Pillar 1, if you are not looking at it, taking that principle in your bilateral APAs, it's limited in scope because it only applies to 20 billion plus companies. Therefore, the revenue gain may be minimal for small economies particularly. And not only revenue gain, please don't look at amount A. We need to look at what is the amount A, plus the amount A can get reduced by already the profits which are in the jurisdictions through the marketing and distribution safe harbor, the details of which are still under negotiation, and through an elimination of double taxation, where depending on the return on the assets and the payroll, it is possible that you may lose some part of your existing profit. And therefore, one needs to be not only careful what a country will get, one also look at whether the country will like to surrender part of what it is already getting. Pillar 2 is, as we said, it's ensuring a minimum taxation, 15%, and through subject to tax rule. I won't go into details. You are all aware of it is, but it is equally complex. The Pillar 2 income inclusion rule is equally complex. And though I don't buy the two other arguments, but these arguments are made that countries lose their fiscal sovereignty and non-tax incentive in place of tax incentive may come. But I personally support Pillar 2 not having a tax as an incentive for businesses. Businesses should go for non-tax purposes for business, and tax should not be a factor in their business. And this may help all countries, including small countries, where MNEs may not be able to bargain tax incentive, because one can always tell them that if I give you this tax incentive, you'll be paying this tax in your resident country. So why should I give you this incentive? Next slide, please. Next slide. This is event 12B. Broadly, you are aware of this, but it is considered simple, and it is simple only if we follow the final withholding tax. If we go for tax on qualified profits, that is 30% margin of the group profit, most of the complexities of Pillar 1 will come into picture. And withholding tax always is a blunt instrument. You can never apply it perfectly. Therefore, whatever rate you agree, whether 2, 3, 4, 5%, there will be some companies which will be undertaxed. There will be some companies which will be overtaxed. And there may be situations where companies are making losses maybe have to pay tax. And there may be situations where companies making super profits may not pay their proportionate to what they should be paying. And there are, of course, other things like it is limited because it's only based on a payment which is going out of the country, and therefore it doesn't capture unlike the Pillar 1 based the revenue that is attributable to users or say advertisement, those who see it. So that part is not also covered by 12B. Next slide, please. And now coming to Indian experience, as I said, since given our dissatisfaction with the existing international tax rules, which we have been voicing for the role for the market since almost 20 years now, we introduced equalization levy based on the recommendation of the Action 1 report in 2016, only on online advertising. And it was the primary responsibilities on the resident payer, who is paying to the non-resident, and it was only a business to business. And the compliance was relatively simple, and we did not have much difficulty in having this levy on the ground. And mostly the compliance is based on self-reporting, and we have been reasonably happy with so far it has progressed. In 2020, we went beyond B2B. It went to business to consumer. And therefore, since consumers cannot possibly have withholding tax regime, the responsibility shifted to non-resident operator or supplier of goods and services. And this is also is operating quite reasonably well, and our equalization levy revenue is growing year to year in a substantial manner. In addition to equalization levy, we had a significant economic presence, which applies to double taxation avoidance agreement. The equalization levy is outside the Income Tax Act. Therefore, it doesn't apply to double taxation avoidance agreement, and therefore it is imposed in respect of also companies, irrespective of the DTA provision. But the significant economic presence applies if there is no DTA. There, if you have sales in India, you have users in India, you have transactions in India, then beyond a threshold, then there is a permanent establishment team, there is a significant economic presence or a business connection, and you are liable to pay tax in India. But mostly, since India has a wide network of TTs, like more than 96 TTs now, this is more of a statement of intent of the government about the policy consideration that it wants should be part of the international tax debate and should be part of the international tax rules. Briefly, I will refer to this report. This is the report by a committee. This is not the report of the government. Not has been accepted yet. But this is something of the nature which was discussed in European Union earlier, where there is an attempt to say that where we don't have accounts or where we have non P, I mean, where we have a significant presence P type without a physical presence, there possibly the profits can be allocated even in physical or non-physical stage, depending on your asset, payroll, and sales, or in case of digital companies in respect of users on threshold like either 33% or 25%, depending on the factors you are using. Next slide, please. So broadly, I think the question was whether we go for multilateral, unilateral, or something in between. And that was my question. As I said, there are many questions of which there is no answer. But I have just attempted, I've flagged some issues which as a practitioner or as an official in the tax policy unit of your government, you can consider these things and then advise your ministers or senior authorities what decisions they can take. There is no right or wrong answer. All options needs to be looked at. So addressing the problem, which one is the best? I think as Professor Craig said, I think this is the pillar 1, pillar 2 is the most comprehensive solution. It addresses all companies, maybe the threshold may be low, high now, but technically it addresses most of the problems. So and in any case, digitalization is a multilateral problem, and therefore it needs a multilateral solution. It cannot be solved bilaterally between two countries. UN 12B is a good solution, but it will be not effective even if unless the real residence countries where the MNEs which are located, let us say United States or European countries, unless those sign up 12B, the 12B will not be that effective. Countries which do not hold residents of we are not resident countries of the digital MNEs, I mean, those 12B will not be that much effective. Equalization levy and DSTs, as I said, they are temporary solutions. They cannot be permanent solutions because WSTs are never permanent solutions for taxing. Final withholding taxes are never permanent solutions. Without tax credit on the other side are not perfect solutions, and they are really blunt. As I said, you may overtax companies, you may undertax companies, and these are, as I said, not a comprehensive or a permanent solution to the problem that we are discussing. The revenue impact, we should be very careful on pillar 1 on this. I mean, it may look that 525 billion or maybe 700 billion, it has gone up, whatever. What will come to smaller countries is based on sales, and also what is being reported in those countries will be factored in while deciding how much a country will get. So for small economies, it's likely to be minimal. In many of those countries, many of those companies may not be operating in that country, and many companies which are operating may be out of pillar 1. So we need to take a call on there. And UN 12B and equalization levy, they'll provide reasonable revenue. UN 12B only if WST is applied. Michael was referring to a paper by South Center, which all of you can refer to, and which also gives an example of if you have a WST of 4%, you may likely to gain good revenue compared to pillar 1 in most of the developing countries. But as I said, these are studies which, you know, I have been working in tax policy for long. It's extremely difficult to project a revenue, definitely, but you need to have some revenue figure, of course, before you take a call. Implementation will be complex in respect of pillar 1, pillar 2. Definitely, it's a very complex rules. There are new dispute resolution mechanisms, and we have never taxed a group as a whole, where it will be relatively simple in 12B and equalization levy. Possible trade tensions will not be there in the first two, but there will be trade tensions possible in equalization levy or DSTs, which the countries which have imposed have faced. That is one part of the record that you need to consider. There may be some effect on your bilateral investment treaty commitments if you are withdrawing incentives pursuant to pillar 2. That needs to be considered because that has happened earlier. In case of countries which joined European Union and withdrew their incentives, they have been slapped with huge arbitration awards. That needs to be considered. And there may be some second order impact. As I said, I don't buy the argument that you lose fiscal sovereignty or the FDI dependent tax incentives will go away. I think ideal situation, the countries should not be forced to provide tax incentive that will be provided by pillar 2. So, but the second order impact in respect of UN 12B and equalization DST, which we have seen in a few cases, even in India also, And for the public statement made by a few of the companies which were subjected to this is that this tax may be passed on to the consumers. Next slide, please. Having said this, there are several other low-hanging BEPS countermeasures which all countries should consider, even smaller countries. These are extremely easy to implement. Their model rules are available, model laws are available, like interest limitation, Action 4, where interest is a major BEPS payment. We can, to the extent possible, implement a transfer pricing audit for which you need CBCR, master file, and local file, if those can be implemented. And of course, in the next stage, if you have got a good transfer pricing audit experience, you can move to secondary adjustment. In case somebody is interested, I can discuss this later on. But as I said, on VAT is a good option for cross-border services. For all countries must consider this. There is already the Action 1 report which provides guidance, and I think there is already a model legislation and model framework on this by OECD. This is something very good product of the last BEPS 1. But as I repeatedly said, it's no substitute for CIT. So the corporate income tax is something different. It must come either through Pillar 1 or through Event 12B or through digital service taxes or something. VAT and all those three, one of those three should coexist. They are not substitute for each other. Next one, please. Next slide, please. I think that's what I wanted to say. Broadly, as I said, things are not easy. We need to understand. We need to enter into any agreement before we decide on a policy option with our eyes wide open. Need to stay engaged. Need to go through papers that are coming out so frequently from everywhere. There are several articles, write-ups on this. So we need to be up to date as tax policy analyst or tax policy officer in our respective ministries, and we decide what is good for the country depending on the data we have. I think the data you have in your country, nobody has. So depending on what type of businesses are there, which companies are operating, what type of transactions are taking place, then after considering all this, you can take a final call. Towards the end of my presentation, I have given several references on which my presentation is based, and there are also documents available in the public domain. I'll request all of you, when you have the chance, please go through this. These are all, so far as the first two are concerned, this gives our Income Tax Act, where I have spoken about the equalization levy detailed legislation, also the significant economic presence, and all the OECD documents and several articles, including Mike Leonard's article, and there are other articles by other professors of Oxford and other areas in, I think there are several academic research on this. I have tried to give some, but once you go there, you can find reference in those articles to this. So with this, I will end, and thank you very much.
Thank you so much, Resmi, for this extremely clear and extremely densely packed presentation. So it's a lot to digest, and also thank you for sharing all the references. I think one of the things that ESCAP can help the policymakers do is to instead of asking all the policymakers to take their precious time out of policymaking and to read all the literature, we can help them as partners and development partners and UN. We can help them to go to this literature and read and digest, and then translate the rich academic or policy discussion into more user-friendly policy guidelines. So I think that would be a very fruitful work to do. Okay, so without any delay, let me just open the floor to see if there's any question. Or it's it's approaching lunchtime, and people are just having already too much information to digest at the moment. So I think, okay, that's fine. I think what we, as we said, what we would do is to put all the presentations on our website. And I noticed that probably only half of the registered participants just show up in this workshop. So we'll also share all the information with all the registered participants to reach a broader audience. So I think that would be helpful, and they can refer to presentations of our speakers today whenever there's a need. So I see a hand from Shujat. The floor is yours.
Thank you. Thank you, Chang. You might be assuming that I'm all over the workshop and asking questions again and again. Thank you very much, Professor Rashmi, for your presentation. Can you just relate this whole scenario which you presented with the years back reforms which India did in their tax system and making it a single unit or a centralized system? Can you just relate this whole scenario to that perspective?
Yes, as I said, we are having the direct tax challenges are coming partly because the non-residents service providers are providing services in our country. Now, as Professor Craig was explaining, when there is a domestic supplier, we impose GST, VAT, or some sort of excise. But when there is a non-resident service provider, there was normally no such VAT. And in the Pillar 1, the BEPS 1 Action 1 report, there is a complete big chapter on this, on how to impose a VAT on the cross-border services. So this is imposed on the cross-border services centrally, of course, by the Indirect Tax Department in Government of India. These are mostly based on self-registration, and I think the service providers are voluntarily paying this tax. They are collecting this tax from the Indian consumers and paying the tax to the Government of India. And so far, it's working quite well. The only point I wanted to make that this doesn't mean that if you are collecting VAT on cross-border services, it doesn't mean the income tax component, because this VAT is paid by your own consumers. It's the company is not paying anything, that any tax on the income it is getting from providing these services. So therefore, the income tax component on this has to come either from Pillar 1, Pillar 2, let us say from Pillar 1, or when you have a UN 12B article in force, or you have a DST or equalization levy, which is actually not an income tax, but it is honestly a proxy for the income tax. Since you are unable to tax the profit, you tax it indirectly through this equalization levy or DSTs, but these can coexist with VAT. So my only problem with some of the narratives that is being projected is that advice to developing countries that don't go for the taxation of non-resident companies, instead go for VAT, which indirectly means that don't tax non-resident companies, but tax your own consumers. I just want the developing country tax practitioners must be aware of this difference, and both tax options are available for them, for their government to take a final call, depending on their economy and what they want. Thank you very much.
Thank you very much. Okay, I don't see any additional question from the floor. So then that brings us to our next presentation. I think that the next presentation would also add the value to the discussion from the practitioner's point of view. So our next presenter is Ms. Rachel Shaw, who is head of the Asia Pacific branch of the International Bureau of Fiscal Documentation, IBFD. So for people who may not be familiar with IBFD, so this is a leading world authority on cross-border and international taxation. It was established in 1938 and has more than 200 employees in 40 countries with access to a large network of tax experts worldwide. So it is widely considered as a partner that tax practitioners from all over the world can rely on for high-quality independent tax knowledge and research. So Rachel, the floor is yours, and we look forward to hear from your perspective on the same questions we have been discussing again and again today.
Thank you, Cheng, and thank you to you and ESCAP for having me here today. I'd like to check that you can see my slides, because I can't tell from my point.
Yes, we can. But do you want to put it in the slideshow format?
Yeah, I tried that and it didn't really work. So I'll try again. Yeah. Okay. So
okay. Actually, this makes the slide smaller. I don't know whether this is the same for other participants. Yeah, but can we? So okay, in that case, can we just go back to the original version, which I think is actually larger?
There we go.
Yeah, and for the other participants, could you kindly mute your mic? Thank you.
So good day to everybody, and thank you again for having me here today. So we can't talk about the taxation of digital economy without mentioning Pillar 1. And since Pillar 1 has been proposed, it has taken all of us a little bit, I think, aback with what was kind of the magnitude of that proposal was really huge. Now, thankfully, my presentation isn't about Pillar 1 or Pillar 2, but things outside of Pillar 1 that we can consider when we are looking at taxing the digital economy. And why would we want to look outside Pillar 1? Well, as you have heard from all the experts earlier today, firstly, there is no panacea, there's no miracle solution when it comes to taxing the digital economy. Neither the OECD nor the UN can give you that. And also, one thing that we also need to consider is there's a lot of uncertainty with regard to any of the proposals that have been made. Now, since 2019, Pillar 1 itself was introduced as a work in progress, something that hadn't been completely defined or finalized, but a show of intention as to where it wanted to go and what it wanted to achieve. We are ending 2022 and it still remains a little bit of a work in process. Now, that doesn't take anything away from it. It is, as I said earlier, a huge undertaking that was being made, and it is only right that time needs to be taken. And in that time, we have seen the nexus that has been proposed under Pillar 1 revamped. It originally didn't take into account a lot of the views of the developing countries. It had a very high threshold, and that was subsequently revamped to look at the MNEs and look at the GDP of the developing countries, and a lower threshold of euro 250,000 was introduced. Professor Alif, in his earlier presentation, talks about the pillar, well, talks about it as a compromise. And I think that's where you see the compromise having been made with regard to developing countries. And that makes you question whether or not how much is actually being compromised at the end of the day to get a consensus among all parties, and really what does that do to the objective of Pillar 1. Another issue with Pillar 1, I think we find that is that there is a huge focus on Amount A. Amount A and determining its impact. Now, for a lot of smaller countries, Amount B is equally important, and there is not enough study or data out there on what would happen with Amount B. So there are a lot of issues within the proposals that put out there that are beyond the control of a lot of countries and developing countries. And that's why it actually serves us to look outside of Pillar 1 when we're looking at taxing the digital economy. Another thing to keep in mind is that, like I said, this was introduced in 2019. MNEs have had a lot of time to consider what damage or potential damage to their profits we're looking at. So things could have been put in place that we are not aware of to minimize the actual tax that will be received by countries, be they developed or developing. And with all this uncertainty surrounding Pillar 1, what we can do is look at other measures that sort of mitigate this uncertainty and maybe bring things a little back under control within our own domestic tax systems. Within the AP itself, we have seen a mixture of DSTs, of withholding taxes, GST and VAT measures that have been put into place, partly because the Pillar 1 proposal itself was a long time in coming, and a lot of countries could not wait for a universal or global solution and decided to take a lot of unilateral measures upon themselves. Now, as you can see, and I'm going to try to adjust this a little because I have no idea why this has happened. We do have a mixture in the AP region of both types, direct and indirect. And just at a quick glance, you can tell that the indirect tax measures outnumber the direct tax measures. As we talked earlier, there has been a mixed response to all these unilateral measures being taken. I found Professor Chui's presentation fascinating. It is a solid argument that he has put forth, but I do wonder to what extent we would be able to argue along the same lines with all the stakeholders as tax authorities or with our ministers. It is a concept that is sound in its principles and theory, but maybe not so easy to put across to the relevant people. Um, it's one that is hard to argue. And also, I would reiterate what he said, that while the downside of DSTs has been much published about and talked about, um, and therefore, and in his opinion as well, that it has been greatly exaggerated, the potential upside to introducing a DST has also got to be carefully considered by countries. Now, the reason for that is that it is a major undertaking. It does have repercussions, as we have mentioned earlier, in terms of not only tax but trade. And therefore, you want to make sure that whatever you're introducing is going to give you back enough of a benefit. Uh, and this also, I think, will go on with a lot of the other measures that we have out there, be they GST or VAT or withholding taxes. The careful consideration of your own economy must be understood before you adopt any sort of unilateral measure. Now, with these unilateral measures out there, of course, the thing that has to be talked about is, as Michael mentioned, if you adopt Pillar 1, when you sign on, you undertake to grandfather out or eventually remove these unilateral measures. And so that is why you will see that there has been more of an uptake with regard to GST and VAT. Pascal Sanaman has said before that GST and VAT, in his opinion, falls firmly within the tax sovereignty of a nation, and therefore it is not something that would actually threaten Pillar 1. However, as we all know, Pascal is no longer there, so that remains to be seen. But the other reasoning behind it is that GST, as again mentioned by Rashmi earlier, is a consumption tax, and therefore the sanctity of corporate taxation of a resident company remains untouched. And so we focus on consumption taxes and why a country would look into adopting consumption taxes to tax the digital economy. Well, consumption taxes are already there. They have better scope, relatively safe in the sense of what I mentioned earlier when in discussing Pillar 1 and Pillar 2. Consumption taxes are more or less left out of the ambit and left within that of the sovereignty of a nation, and therefore most likely you would be able to continue to have consumption tax regimes for the digital economy um, without fear of retribution of some sort. Also, many countries already have a consumption tax system, and I refer back to what the the earlier person talked about why we would have a consumption tax, why would you introduce one? Well, you already have the system set up. So your administrative costs, your implementation costs are immediately negated. That's already down. So what you actually only need to look at is how to define the scope of services and how you would capture that kind of taxation, how you would tax the non-residents, how you would tax the consumers. It's a system that, like I said, it's already there in terms of administration, in terms of compliance, in terms of payment. Now, also, I think the argument has to be made for it is, like we said earlier, that it levels the playing field for your domestic suppliers. And I think that is a keynote that needs to be done there. That inequality in itself has to be addressed, and therefore consumption tax has its specific role to play here. What must be considered is that if you are going to go down this route, the tax administration needs to be modernized. In order for this to be done efficiently, and by that I mean at minimal cost or as minimal as can be, and effectively, the tax administration itself has to be modernized. It has to be digitalized. When we talk about getting non-resident agents to register or pay, nothing is more attractive than the ease of compliance, and that comes with digitalization of the process from start to end. We have found also on our end, a lot of countries have told us that there was this fear that non-residents would not register and would not comply, but that was eased with having systems that have been set up to facilitate such registration quickly and easily, and for the payments to be made as well. So a seamless process is what is required if you're looking to target these non-resident companies. Things that will also have to be considered when you're looking into the modernization would be further down the road when you're looking at e-invoicing, identification of your influencers, your content creators, your freelancers, all that comes with information and data that can be captured or identified with a very modern tax administration system, accessed across interagencies. So that's something that would need to be considered. Which is a nice segue, I think, into another workshop that the UN is having tomorrow on modernizing the tax administration. It is something to consider. And finally, the last thing about consumption taxes, which I would say you have to be careful about, is that a tax on the consumer um, is a tax on your voting public. And we have seen before what introduction of consumption taxes can do in terms of elections and having governments in. So that is something that needs to be considered, and there has to be really high political will in introducing a consumption tax or a new one. And along with it, if you've already got an existing consumption tax on all these various components, you might want to consider not only unifying it, but um, a having a specific strategy and marketing objective of informing your taxpayers what you're doing, whether or not this is going to increase their tax. And maybe it may be that it's not. Maybe by unifying everything, you your consumption consumers are actually paying a lower tax at the end of the day, and that message has to be put across to the taxpayers. So then what are the other possibilities that we have beyond the pillar one and beyond consumption taxes? There is, of course, as Michael said, Article 12B. Now, what Article 12B does is is simplify, and there is a lot of beauty in simplicity, especially if you're looking at administrations that need to adapt and to implement and execute these well these measures. You know, it's easier to explain to a tax officer how 12B would work than how Pillar 1 would, and there in itself is some value to be had. Because Rashmi talked about how you would need the resident countries to sign on if you wanted 12B to be effective. But I would remind everybody that even Pillar 1 itself, it's looking at high value M&Es. What it does not consider are other M&Es which may not reach that revenue target, who are just short of that threshold. There are other M&Es out there that are growing, which may be of great value to other countries in other regions. We're looking at the startups. We're looking at maybe the smaller national companies, the Gojats, the Grabs, who are building their business and reforming the industry. They may not qualify as an M&E under Pillar 1, and therefore they fall, in a sense, out of scope. And perhaps that's where 12B comes into play, on the basis that it's not a zero-sum game, on the basis that when Pillar 1 is finally rolled out and people have signed up, you are allowed to use something other than Pillar 1 for M&Es that do not fall within the threshold. And that is something to consider. One thing we should, so from there on, we look also at not only the digital economy itself in terms of your Google and your Netflix and your Amazons and Facebook. You have to look at it in terms as well as all the other industries that have benefited from this growth. We're looking at your logistics companies, your ICT, your telcos, your dropship agents, sometimes the companies that support all these digital companies, which have a physical presence and a local presence. Digital nomads were mentioned, how you would look at content creators, how you would look at um, all these influences. So these are other things that small economies should be focusing on as well. When all these global propositions came out, we may have gotten swept up in all the international cooperation that was required. Everything that came out is such a fast pace that we were all required to sort of catch up with, and many resources in the tax administrations have been occupied with complying with these global standards, exchange of information, CBCR, CRS, all these things have been put there, and we've been occupied with that for the past few years. So perhaps now, while there is a bit of a lull in what's happening, we should be focusing again inwards on our own economy and looking at these sorts of growing industries, which, for some, a windfall tax has been implemented. For some, there is some actual intentional drive to nurture and grow. And not only from the digital economy, but also from COVID-19 itself, which the pandemic has brought about many other sorts of industries and put to rest a lot of the old traditional brick and mortar industries, and that needs to be looked at in order for us to decide, in order for countries to decide really where they want to go. There's a lot of untapped potential in looking there, and um, income that could have been, or tax revenue that could have been slipping by. So it's one thing to look outwards, but there is a time to look inwards, and I would say that now is the time to look inwards. Along with that, there are other key revenue streams. With the growth of the digital economy, you would also see the growth of high net worth individuals. That coupled with the pandemic as well, we have seen that there is a big income gap among the populations of many countries, and that gap has grown even more over the past years. I have heard recently that while some countries were able to generate still a significant amount of revenue and GDP, that it was a small percentage of the population that was responsible for that economic growth. And therefore, it's something to consider, is to look again at our high net worth individuals who may have benefited from this growth, um, looking at capital gains. If you don't have a capital gains system, so, many countries don't, but looking for capital gains tax is one way of ensuring that there is a redistribution of revenue and income. Um, and then we also need to look at upcoming matters such as big data, for which no sort of real sort of solution really has come about. And big data is something that I think all countries would need to look at, and the growth of the cashless economy. These are things, other revenue streams that we could be looking at, and plugging the loop, the leakages there, so to speak, and capturing it better. The other things that we should be looking at are taxpayer compliance and growth, and with that comes the digitalization. Um, and part of it, and a big part of that has connected to the digital economy, because you have now gotten this growth of entrepreneurs, of startups, of sole proprietors who may or may not be aware of what they should be doing in terms of tax compliance and reporting. And authorities should be looking into these, not to stamp them out, but to sort of nurture them and grow them as well, to ensure that they are aware of what their obligations are, to capture whatever data or whatever income you can, and also to ensure that they don't fall foul of tax laws. The last thing you want is maybe to have a growing SME that is probably going to do well, really growing in industry, but because they were not quite sure as to how to go about their tax obligations, they may have fallen foul, they may have penalties, they may have incurred a huge tax debt that they were not aware of. And because of that, they have to stop their operations and shut down. And that would be snuffing out any potential that could have been. So what I'm trying to say is that, in looking inwards, we're not only looking to catch people, but we're also trying to get taxpayers who are genuinely unaware and who need some assistance and help in growing. And finally, my last point is that there's very little that can't be achieved from going back to basics. And by that, I mean also back to BAPS. In the massive changes and transformation over the past few years, we have swept from BAPS itself onto BAPS 2.0 and potentially 3.0 at great speed. And what we may not have had time to do was to take a little bit of a breather and stock take where our BAPS action points are, whether the measures that we have implemented for all these for BAPS, all these measures implemented, what they have benefited, whether they have been effective, whether or not they still hold any sort of water in this day and age, whether they need to be revamped. There were many good points that were brought about by BAPS that talked about plugging the leakages and closing off the loopholes, and now would be a good time to look back at those and to see where we're at. So in conclusion, I would say that a bit of introspection is required by all countries. Again, there is no miracle cure. Everything has to be any action taken has to be in consideration of your own economy, of an understanding of your economy and your taxpayers and the other jurisdictions that you trade with. And I hope that that has given you a bit of food for thought. And with that, I thank you all.
Thank you very much, Rachel, for your point. I think that your last point about looking internally, look more closely at the national needs and the national constraints, and then optimize your strategy and policies accordingly. I think that's very important. So for international engagement in the national negotiations and processes, it has the benefits that, of course, it forces domestic reforms accordingly and domestic modernization of domestic policy and tax administration practices, so on and so forth. But at the same time, it also consumes a lot of the best talent from our developing countries in the tax authorities, right? So obviously, we this balance between the investment and the payoff, and also whether to target the low-hanging fruit or to aim high and look for long-term benefits. The balance is art. So it has no definitive answers, but I think the point that you highlight is very valid here. So let's quickly open the floor again to our participants. Okay, I see now. And we are also 15 minutes late from our schedule, so I think everybody is eager to go for lunch now. So without further ado, let's bring in our last speaker for today, who is Matthew Andrew, who is an expert from the Asian Development Bank on BAPS and including the two-pillar solution. So Matthew, the Asian Development Bank is a very active technical provider for technical support and capacity building for Asia Pacific developing countries in the region. So and also ESCAP and ADB, we have been long-term partners on various issues, and tax is a topic that we have recently stayed in touch in the past several years. And we are very happy to have you here, Matthew, to share your perspectives on the topic, and also maybe a little bit on the ADB's work in this field. So the floor is yours.